We've got a deteriorating fiscal situation here, and slower economic growth and tariffs will only make it worse.
We don't know what the pass-through of expected and actual tariffs.
What the market is playing now, in particularly the last week and a half, is increasingly recession fears.
The uncertainty is the more immediate threat, and I think it's more likely that we'll come out of this with just a slowdown.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, looking for some relative calm after snapping a two-day losing streak in yesterday's session. Equity futures struggling to build on those gains as Washington heads towards a government shutdown.
Funding the government should be a bipartisan effort, but Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR.
Senate Democratic leader Chuck Schumer pledging to block the Republican spending bill heading into a weekend deadline, teeing up a busy 24 hours in the nation's capital. Commerce Secretary Howard Lutnick set to meet with the Ontario Premier Doug Ford later on today, attempting to bring down the temperature with Canada.
When the biggest client, the biggest trading partner, the most important counterparty you have, who really, really matters to you, the first thing you do is show immeasurable respect. Say thank you.
You say thank you. Secretary Lutnick joining us a little bit later on this morning, 8 o'clock Eastern Time, 2 hours from now. That meeting, front and center.
The question of can they bring down the temperature, and is this still a drug war? Are we moving into the April 2nd question of actually the new tariff regime at a time when a lot of people are saying, just tell us what the ultimate goal is. Maybe this is a feature, not a bug, but a real question of when it starts to matter that confidence is getting affected.
Who should be saying thank you to who? Because the Chinese foreign ministry official came out in the last 24 hours saying exactly the same thing about the United States, that somehow the US should be saying thank you to China.
That's definitely not going to happen anytime soon. And what China was talking about said they've been cracking down on the product, the particles that go into fentanyl. But I don't see that happening anytime soon, even though there are reports, Jonathan, that maybe there is planning for a meeting between Trump and Xi in the spring and in the summer. When it comes to this meeting with Canada, what I will say is that what you heard from Canada yesterday is that Doug Ford met with Mark Carney. They said they're not backing down, and they will go dollar to dollar, tariff for tariff with the United States.
So they've put new tariffs on $21 billion of U.S. goods. And my question for Commerce Secretary Howard Lutnick later on this morning will be, does that change your approach to this meeting? Does this meeting even happen? What happens when this conversation starts? Is that the first thing you bring up?
Yeah, what's the goal of this meeting? Is it to have them take off any potential tariffs? Is it sort of one ultimate goal when it comes to drug war? Look, I think it's important for the market and for consumers to understand exactly what the off-ramps are at a time when we seem to have a never-ending ratcheting up of tensions. And you have to wonder if the response to even good news is tempered that much more in markets as a result of this ongoing churn that we just keep expecting.
So a great example of that, and I'm sure you're alluding to it, is CPI yesterday. CPI comes out, downside surprise. What do bonds do? Yields rise. They fell initially, and then they started to climb. The attention of this market is firmly elsewhere.
So there are a couple of different interpretations of this. On one level, you could just say the bond and stock markets are singing from two different hymnals. On one hand, the stocks are optimistic that the best case scenario will come out, and the bonds are the worriers that are sitting around saying, this is all looking a little scary to me. If you look at the actual components of CPI, the components that go into the core PCE, which is what the Fed looks at, weren't that much softer. So some people looking at the actual details, but on a larger sense, worries very much shifted to tariffs, very much worried to growth, and very much worried to the deficit, which alludes to the potential government shutdown.
The next data point we're looking for, 8:30 Eastern Time. We're looking for PPI and jobless claims. This deadline for a government shutdown, I ignore it, and all of a sudden, you've got to start paying attention. Are we paying attention now?
We're definitely paying attention, but you might be able to ignore it. There's really two paths here. One, it could be political posturing. They want to invoke cloture. Maybe they can do that if the Republicans say, we're going to give you a vote on an amendment. That would be political theater, according to Jake Sherman. The other scenario is the Democrats hold firm, and we are in a shutdown after midnight on Friday.
Big 24 hours coming up in the nation's capital. Big 60 minutes coming up on this programme. We'll catch up with John Stoltzfus of Oppenheimer, staying bullish on equities. Ed Mills of Raymond James as Canada strikes back against Trump's tariffs. And Greg Daco of EY on upside risk to inflation. We begin this hour with stocks struggling to build on yesterday's gains as growth worries linger on Wall Street. John Stoltzfus of Oppenheimer staying bullish, writing, "We remain positive on equities. The broad rotation which began in the rally from the S&P 500 low on October 27, 2023 has repeatedly deflected volatility." John joins us now for more. John, good morning.
Good morning.
Good to see you, sir. Does the policy changes, does the policy uncertainty change your view at all?
No, it doesn't. In fact, we would say, if anything, the policy uncertainty takes us to say, well, this is just about what you would expect. This is something, it's Monty Python used to say, and now for something completely different, if you consider the difference between the prior administration and this administration. We can't help but think, it's very natural. The prospect of tariff wars that could last is very concerning, okay, to business, to the consumer, and to governments alike on all borders. But we can't help but think that this is a process. This is the first president. And by the way, I'm not an apologist for the Trump administration, nor was I for the Biden administration. This is politically agnostic. It's a business person talking. When we look at it, for 80 years now, the U.S. has, in effect, had a very lax policy towards dealing with tariffs against our products. For decades, we have now exported our production, and the result of that is the rest of the world are the producers and we're the consumers, and without us, those other countries would suffer significantly. They have overcapacity in Asia, in Europe, they have overcapacity in Latin America. This is, for years, we have been building up, the world has been building up capacity to export to the U.S.
We can park the politics. I think you just have to focus on the policy and the objectives. And the objective is pretty clear, given everything you've said. Rebalance the U.S. economy, rebalance the global economy for that matter, and accept, in their own words, some disruption, a detox. What does that mean for markets?
Well, I think what it means is right now we're going to be affected very much by an increase in volatility. That's quite natural. We think the way to weather it is with prudent diversification that meets the needs, objectives, and the tolerance to volatility for an investor or an institution's mandate. But it's not something that is indigestible. If anything, it's something that has to be digested at this point, because it's the first time we've ever seen an administration not kick the can down the road in terms of the cost of government versus services actually rendered, the tariff regimes around the world, and could actually, once people can meet at a table and cooler heads prevail, I think work out pretty well. The initial part, there's a lot of political jostling. Everybody is working to get their constituency to say, stand up for us, and whichever side it is. But once you get over that human lack of ability to get down to brass tacks quickly, once you get to it, I think we get to a much better situation and a re-globalization, which should be good for both developed and emerging markets.
To be clear, I think a lot of people would agree with you, and a lot of people in the business community would agree with you as well, particularly in the United States, who have alluded to exactly what you're talking about. The issue is the near-term volatility of headlines and the path to get there, some of the negotiation tactics that are making people concerned about how long it might take to actually get to that place. You say that you need to right-size expectations for how certain assets will respond to volatility. Does that basically mean that you think that they should lower their expectations for a whole host of different assets?
We would say, it being realistic, it's like near-term lower expectations, and understand, for example, the sell-off that we'd seen in the financial stocks, for example, let alone what we saw in technology. Well, they had a phenomenal run last year. So a good place for a haircut or a trim or even a correction would be amongst those two sectors and others. So just live with it rather than dump and run. You stay with it, you're diversified, know what you own, know why you own it, and have right-sized expectations. And like us, you might be pleasantly surprised over the course of a 40-year career.
Well, when you talk about diversification, it's taken on a different meaning over time.
Yes.
There was a question around bonds diversified. There was a question around whether gold was the ultimate diversifier. There was a question with geographies versus sectors. How has your understanding of what it means to be diversified changed in an era where there are some pretty seismic changes going on from the policy perspective.
I would say diversification today, the approach should be very much like one that is parallel to the one in fixed income, which is considered duration. Here it would be the duration of the need. In other words, are your objectives long-term for retirement? Are you a retiree who is a relatively young retiree? How long are you going to need to be exposed to equities to have, based on history, have a greater ability to keep your standard of living? And so we are really at a point now where, the old days when the private investor would appear, they were usually the retail investor. It was cocktail parties, stocks that they would talk. Now today, people invest for need because they recognize the fact that things like Social Security will likely not be anywhere near the benefit percentage-wise what it once was for their parents or their grandparents.
When we have this policy uncertainty, though, and we see that bleed into the markets, we see pullbacks, are you advocating people buy more?
Yeah, we actually are advocating dollar cost averaging. We don't say buy the dips, but we say buy the babies that get tossed out with the bathwater. The type of volatility that we are seeing now, we have seen parallels to it in the great financial crisis, in COVID. Remember when COVID struck? I'll never forget in April of what was it? April of 2020, wasn't it? Yeah, April of 2020, you had some of the smartest people in the world on shows saying it could be decades before they find a cure for this deadly virus.
Is that how they all sounded?
Well, it did to me, and then we had, at that time, Trump was in the White House, and he said something to the effect of, well, we could have, in his own inimitable voice. I'm not going to get to imitate the president, but he said we could get drugs in a warp speed, and within a short period, relatively speaking, we had it. We don't wear masks today.
We had a lot of fear, though, cross-asset, and you saw that in credit, too.
Yes.
You could make the argument this morning you don't see that in credit at the moment. I think it was Jonathan Krinsky yesterday of BTIG who said that market bottoms need doubt. Do you think there is sufficient doubt that you can buy this morning?
I wouldn't back up the truck, but I don't have any problem with layering in at this point.
Where would you layer in? Because there are a lot of babies, to use your words, that have been tossed out. Tesla, Palantir, Nvidia, the list goes on and on. Even Apple was struggling yesterday. Where are those babies?
Well, okay, as you know, because I manage money at Oppenheimer, they don't let me pitch
just
stocks,
describe
but
the
I give you the
opportunity.
sectors.
Sure, please.
Information technology, communication services, which has the search engines, the streamers, and the social media. I would also be looking at a consumer discretionary. The American shopper persists at shopping, even though now at discount, private label perhaps, but still shopping. Businesses are still doing what they're doing. And so we would look at financials and the industrials. The industrials are so well positioned to take us into the next chapter of AI, industrial equipment that needs to be advanced to create all kinds of developments in terms, whether it's the electric grid, whether it's medicine, whether it's just in finance, what it can do to help us get through all the data that gets produced.
What about the travel names, John? Given the downgrades we've seen from the airlines earlier this week, what about the travel names?
I would have to say that's not surprising. Airlines have been remarkably strong for a fairly long period of time. We've never been big fans of airlines, whether we're at the airport or whether we're considering what to buy, only because of the nature of that business and the ability of the traveler to suddenly stop traveling abruptly or keep traveling much longer, the ability to charge ridiculously high fares. Still, I haven't been to Europe in years now since before COVID.
It's getting expensive. It's Lisa's fault.
But my point is what happens is we need to see more competition come in, and that's going to hurt earnings.
What's the old joke? The fastest way to become a millionaire? Start with $1 billion, buy an airline, something like that.
There you go. And I think Buffett learned that years ago at one point. I can't think of was it U.S. Air, or there was some airline that Buffett took a position and he limped away from it, which he rarely limps away from.
A lot of people have been burnt over the decades, that's for sure. John, it's good to see you, as always. Appreciate it. John Stoltzfus there of Oppenheimer. This just drops from Torsten Slok over at Apollo. He calls it a wait-and-see economy, and he says that in a wait-and-see economy, eventually it leads to a slowdown in the hard data. Markets should prepare for that scenario. So just an alternative view compared to what we just heard from John, just dropping from the team over at Apollo.
Yeah, and we'd heard about small business confidence dropping to a 4-month low and some of the internals of that. Torsten points out that those small businesses account for about 80% of total U.S. employment. So you will see it if that lack of confidence and lack of action does continue.
Look out for jobless claims later this morning as well at 8:30 Eastern Time, a few hours from now. Equity futures just about unchanged on the S&P 500 with an update on stories elsewhere. Let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. U.S. Senate Democratic leader Chuck Schumer says his party will block a Republican spending bill to avert a government shutdown on Saturday. Schumer urged the GOP to accept a Democratic plan to provide a month of interim funding instead. Let's get a check on the shares of Intel, up 11.5% in the pre-market. The company named Lip-Bu Tan as its new CEO. The former board member and semiconductor veteran has a large task ahead of him: restore the fortunes of a pioneer chip maker that's become an industry laggard, struggling with market share losses and manufacturing setbacks. 2 NASA astronauts stuck in space will have to wait a little bit longer to get home. A launch pad problem prompted SpaceX to delay a flight to the International Space Station. The new crew needs to get to the International Space Station before Butch Wilmore and Suni Williams can head home after 9 months in orbit. And that's your brief, John.
Danny, thank you. You know my position on this story. Should be the biggest story in the nation.
We still have 2 people stuck in space.
How many people actually know their name, though? Butch and Suni.
Yeah.
How many people actually know
I know,
that?
but can you say their last names?
No, I can't.
Yeah, I can't.
No, they
either.
should be household names.
I know, it's true. And what are they doing in there? I want to know. How are they spending their time for 9 months up in space?
With great difficulty, I imagine, given they were meant to go up there for a few weeks. Got to figure this out. Up next on the programme, Canada fights back.
The government of Canada, following a dollar-for-dollar approach, will be imposing 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States.
To my European colleagues, we will work together to put pressure to end these tariffs against you too.
So it's a team effort now. Ed Mills of Raymond James joins us next to break it down. From New York City this morning, good morning. Snapping a 2-day losing streak in yesterday's session. This morning, just about unchanged on the S&P 500. Over in the bond market, yields up a single basis point. The 10-year 432.39. Later this morning, PPI data and jobless claims as well. 2 data points to look for at 8:30 Eastern Time. Under surveillance this morning, Canada fights back.
The government of Canada, following a dollar-for-dollar approach, will be imposing 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States.
This is going to be a day-to-day fight. To my European colleagues, we will work together to put pressure to end these tariffs against you too.
A united front. Here's the latest. Canada striking back against the United States with new levies taking effect today. Canadian officials set to meet with Commerce Secretary Howard Lutnick as they seek an off-ramp to the trade war. Let's get to the team coverage with Bloomberg's Tyler Kendall in Washington. Divya Balji in Toronto. Divya, I want to come to you first and just try and understand the position of the Canadians as they get set to sit down with the Commerce Secretary. What's their approach to this meeting?
Yeah, I mean, I think it is quite clear that they would love to bring down the temperature. I mean, even Lutnick has said that. I think if it's possible to completely not have these tariffs in place, I think they would really love to do that. But I think there is also a response or an approach here where if the U.S. is going to do this, then we are going to fight back. And I think that's how they're looking at it. When you look at the way they've done things so far, the initial tariffs that took place at the start of March, then they came back and retaliated. Then again, now with steel and aluminum, there is still a whole bunch of goods that they have said they plan on putting tariffs on in a few weeks, lead down this path if we have to go through it. So if they can bring down the temperature, they will. But if they can't, they're going to go ahead and continue along this ride, essentially.
Tyler, when it comes to the U.S. response, yesterday the president says there's no inconsistency when it comes to his tariff regime. He says he has the right to adjust, and he says he's calling it flexibility. Will the Americans be flexible today?
Right. And Annmarie, also important to note that Prime Minister-elect Mark Carney said yesterday that he's ready to have a call with President Trump, but only if the White House respects Canada's sovereignty. As we start to hear senior administration officials this week again repeat the claim that they'd like to see Canada the 51st state, something Canadian officials have said is very disrespectful. But we haven't gotten really any indications from the White House that a call is being scheduled or put on the books, which leads us to believe that this really is just the first step here to try to get these members of Canada's ministry, including the finance and the industry minister here in Washington today. And President Trump, you said it there. He said that there will be flexibility. That's why he's moving with these different targets. But he also said that there will be very little flexibility once those April 2nd reciprocal tariffs come around.
Tyler Kendall alongside Divya Bauchi. To the two of you, thank you. Big meeting coming up later on in the nation's capital. Joining us now to discuss is Ed Mills of Raymond James. Ed, welcome to the programme. I think we've all been slightly confused around the objectives. Let's talk about what the ultimate objective actually is. It started out by being about the northern border, fentanyl, immigration, and then it became about dairy access all over again, and then also in between something about becoming a 51st state. What is the overall objective here?
So I think what we're seeing here.
I think we've lost that connection with Ed Mills of Raymond James just as it started. But I think that's the conversation we've got to have with the Commerce Secretary later on this morning, who, by the way, if you are just tuning in, joins us in about 1 hour and 40 minutes' time. That's going to be one of the early questions. What is the objective? What does the President want? What are the demands for the Canadians that you're set to articulate later on today?
How much really is this still about drugs and not necessarily about a whole host of other issues that are supposed to be unveiled on April 2nd? And right now, people are trying to understand the tea leaves so that they can get in and make plans at a time where they've got ships on the sea coming in and they don't know how many tariffs they're going to ultimately be paying on that.
I look at what the president said yesterday when he said, I'm not going to be inflexible. I can change my position. I have a right to adjust, except Tyler put a great point at the end. Until April 2nd, when you get this reciprocal tariffs. So the conversations today, are they about potentially what's to come on April 2nd? Also, are they about just front-loading, bringing forward the USMCA renegotiation talks? Are they trying to get ahead of that now so the administration can focus on other things next year?
This was not on my bingo card coming into 2025. I didn't think we'd be spending this much time trying to work out the trade situation with the Canadians. I think we all had a good feeling that it was probably going to be Mexico because of what was happening at the southern border, but also how the Chinese had been using Mexico as a back channel to get around some of the tariffs that they'd been put on the country over the last several years. But Canada really wasn't top of the list for anybody.
And it wasn't top of the list that suddenly Donald Trump would be responding to sort of a tit for tat with respect to the Ontario mayor. The idea that Howard Lutnick on a recent interview came out and said that the 50% was trying to get a guy's attention in Ontario. So there's this difficulty in understanding strategy versus goal at a time when you're seeing that start to bleed into confidence. That said, a lot of people agree that there is still time to give confidence to businesses that haven't materially laid people off or made big decisions. But that clock is ticking.
When it comes to strategy, it's interesting. Howard Lutnick in this previous interview was talking about the fact that they like the way Mexico has gone about it. They said the Mexican president has been very classy, getting on the phones, doing the right things. They haven't seen that from Canada. How much is this about what he calls just Canada saying thank you? Maybe Mexico behind the scenes said, thank you.
Well, they've been going through a leadership contest, so they've got their own problems domestically in Canada right now. I think another curiosity for us all, perhaps not for Commerce Secretary Howard Lutnick later, is where this leaves the Conservative leader in Canada, Pierre Poilievre, who had a lead of something like 20 points over the Liberal Party going into this trade mess of the last 4, 5, 6 weeks. They have really turned things around in Canada off the back of this trade story, and they being the Liberal Party.
Which suddenly now Mark Carney is in the lead and is likely to take over. A question more globally about how much this is the case. We're seeing this in Germany. We're seeing this more broadly in Europe. Some of the sort of old school establishment coming to the fore as the main voices to try to get unity for the regions.
Up next on the programme, we'll talk about the economic data later on this morning. PPI data after getting a softer read on CPI, and then later as well, jobless claims in America. Will we see any weakness start to creep into the labour market? We'll get the view of Greg Daco of EY from New York City. This is Bloomberg TV. Equity futures on the S&P 500 just about turning positive this morning by not even 0.1%. Yesterday snapping a two-day slide on the S&P 500. There's nothing too convincing about any of this, though, at the moment. On the Nasdaq 100, just about unchanged. In the bond market, so yesterday, CPI comes out. Downside surprise. Initially, yields fall back, and then they start to climb again. They're up again this morning on a 10-year by 2 basis points, 432.96. There is a takeout there. I think a lot of economists concluding that when we go into the Federal Reserve meeting next week, yes, on the margin, a softer CPI brings some comfort, but the attention, the forward-looking attention is firmly elsewhere.
Especially because some of the components that led to CPI softening are what we already know. American Airlines, Delta, United, airplane tickets have been coming down, travel costs have been coming down. At the same time, other parts of that report really were sticky. And so it leaves today's PPI as very much front and center about whether the Fed actually is looking at a better than expected inflation print on their core PCE or not. And that actually is going to be important.
I wonder if we could perhaps go one step further and suggest just this question: whether events elsewhere, Germany specifically, limit the ability of yields to drop too much in the United States. I just wonder if that puts a floor under the Treasury market at the moment, because what you're seeing in Germany is so profound. The regime shift is so large that it's dragging yields higher worldwide.
We've asked people this question, and everyone has a different answer. Some people say, yeah, absolutely. You have more debt sloshing around in the world and more demand to use your dollars. Well, guess what? You're going to see higher yields. And other people say it might just suck assets from everywhere else. And remember, those money market accounts, they've got to go somewhere. So, there are a lot of counter discussions around this. Either way, the bond market is picking up something that maybe the stock market just isn't.
It sounded like a bullish Southside strategist for about 2 seconds.
I can pretend.
Yeah, that money's got to go somewhere. All that money on the sidelines.
How much we hear that all the time?
All the time,
check out the money market accounts. There are $50 trillion out there on the sidelines.
It's amazing. It'll buy all the stocks.
Yeah.
Equities right now, just about positive on the S&P. I want to finish on foreign exchange. The euro looks like this. The dollar, DXY, over the last few days, new lows for 2025. In and around those levels at the moment. Euro dollar 108.71, just in and around 109. On our radar this morning, President Donald Trump vowing to respond to the EU's countermeasures against his steel and aluminum tariffs. Canada also striking back, announcing 25% tariffs on $20 billion of US-made products.
What I think is so interesting about this, and something we really should ask Secretary Lutnick, is Donald Trump yesterday said he will respond. Is the response going to come before April 2nd, when they say is going to be this, quote, big day with the reciprocal tariffs being announced? Or are we going to sit there and have 3 weeks of maybe some stability and calm and not this frenetic every single day policy change? The Canadian foreign minister said this is going to be a day in and day out fight, which is why this meeting today in Washington, D.C. between Lutnick and the Premier of Ontario and the Finance Minister of Canada is so important.
How much is this a style thing? Come in, say thank you. It would be our honor to be our first 51st state, but frankly, we just can't do it right now. But we really just love having you on our border. Thank you. And then the tariffs go away. I mean, really.
I'm not sure that's going to fly at home. Can you imagine if that actually happened today?
Well, I'm just saying, how much is this stylistic versus actually substantive? And that is something concretely that we don't have a sense of.
I do think some of it is style. You can even see that yesterday. Donald Trump was sitting down with the head of Ireland. Ireland has literally the biggest trade deficit out of all the European states. And yet Trump did needle him on it, but he wasn't very rude or bombastic to the individual. And they said, look, we still have a great relationship. So maybe part of it is a little bit of style.
You'll hear from the Commerce Secretary later on this morning on this programme. That interview is about 90 minutes away. Want to get to the latest in Congress. The Senate Democratic leader, Chuck Schumer, saying his party will block a Republican spending bill to avert a government shutdown this weekend. Schumer urging the GOP to accept the Democrats' plan to provide funding through April 11th instead.
So he basically got up on the floor yesterday and said Republicans don't have the votes. Well, of course they don't have the votes because you need 60. They have 53. That's just the math. Two things can play out. One, they hold firm and we see a government shutdown and they try to pin this on the Republicans. Two, they say, we're going to give you the votes for a procedural moment to invoke cloture, but you have to give us in return a vote on an amendment, just so they have it on the books that they pushed for a different outcome, a.k.a. political theater.
Democrats don't want to block this. Ultimately, there are a lot of Democrats that don't want to end up with this on their head that they cause the government amid all the potential concerns around tariffs and some of the volatility. All of a sudden, if the Republicans can say to the Democrats, you're responsible for the government shutdown that now raises the question of downgrades to the U.S. credit rating, not a good look. So it's very difficult, and I have to wonder what exactly the discussions are like on Washington, D.C.
We've dealt with this stuff, unfortunately, a million times. I think market participants can deal with it. What they can't deal with, the fact we're talking about this means we're not talking about taxes. And that's the issue for a lot of investors right now. It just pushes that back and pushes it back. And we need to be talking about that up front right now. And we are talking about that down in Washington, D.C. The Commerce Secretary, Howard Lutnick, saying President Trump wants taxes for Americans making less than $150,000 a year to be zero tax. He also wants to have no taxes on tips either. So this is the big push coming from the president.
I feel like we're back to the campaign trail of Oprah Winfrey taxes. Everyone gets a tax cut. There's no tax on tips, no tax on Social Security, no tax on Medicaid. It's very difficult to see this when you have the budget deficit rising. But this is something Donald Trump did talk about. He said remove tax on citizens, replace it with tariffs. He talked about this on the campaign trail. This is something Peter Navarro would like to see. But it just does not seem feasible, especially when you look at the makeup of Congress and the fact that they want to bring the deficit down. It just doesn't make sense.
Representative Mike Crapo, Republican of Idaho, came out and said yesterday the price of this bill grows and is a bigger deal than everybody is focused on. Meanwhile, estimates are that it will add $5 trillion to the deficit over the next decade. So a question of how they can feasibly get this done and whether some of the cuts elsewhere really can offset this and then some to really quell some of the deficit concerns.
Margins are small. This is not going to be easy, that's for sure. Of course, we'll catch up with the Commerce Secretary on some of those comments a little bit later this morning, again at 8 a.m. Eastern Time. Let's turn to the economy. Traders counting down to PPI due out in less than 2 hours' time. Greg Daco of EY writing the following. The risks to inflation are tilted to the upside. The combination of still elevated inflation and resilient labour market conditions will keep the Fed on hold at the March FOMC meeting. Greg joins us now for more. Greg, good morning.
Good morning.
What's the source of that inflation, that upside risk to inflation? Where does that concern come from?
Well, I think the first thing to note is that up until today, we still had disinflationary forces. So we're still on this momentum where inflation was moving lower. But we're starting to see some elements that could portend to a higher inflation environment over the coming months. One of the key factors, of course, is going to be this rise in tariffs that leads to higher import costs, higher producer prices, filtering out into consumers. One of the key elements that I'm going to be paying very close attention to in the PPI report this morning is final demand for trade services. That's a proxy for margins, and that's usually a good gauge as to how businesses are passing on the higher costs. Because I'm worried about one thing. Last time we were here, I was talking about PIA, preemptive inflation anxiety. That concept is essentially this notion that there's going to be a much faster pass-through in terms of inflationary dynamics from producers onto consumers in this round of tariffs.
There are two sides, though, of preemptive inflation anxiety. And one side is companies passing along those costs, and the other side is consumers pulling back in preparation for higher costs and just all around a more expensive lifestyle. We're seeing that in the travel sector. At what point will slower demand offset some of the increases that we're seeing in price pressure?
I think that's a second element, a second shock in terms of economic activity onto inflation. The first round effect is really to see higher inflationary pressures. And we're seeing that in terms of uncertainty, because what consumers are doing is essentially hoarding ahead of any potential price increases. What that does is put in and of itself upward pressure on the very goods that are short in supply. We're seeing that also from the business side that are preemptively ordering goods that are likely to be tariffs. We saw in the latest data that trade imports were very strong. That's likely an indication that businesses are front-running any potential tariffs. That strains supply chains, puts upward pressure on supply, and leads to higher inflation preemptively. So those pressures are materializing now and will likely do so over the coming months. Once we start to see demand destruction, we may start to see some offsetting effects, to your point, on inflation, but that's a second round effect.
You know, it's just so interesting to me that we hear this being discussed by central bankers around the world. Yesterday, we heard that from the Bank of Canada, where Tiff Macklem came out and said that this is a new crisis and there's pervasive uncertainty, and discussed the difficulty in being able to cut rates again more significantly because of some of these inflation pressures. Where do you expect central banks to place the emphasis as they face off with the worst kind of dual risk, which is both slowing growth and inflation?
It's a great question, because when the two dual mandates are in conflict, the employment mandate and the inflation mandate, it's very difficult for policymakers to react. And the Bank of Canada said it well yesterday. Central banks are not equipped to deal with trade shocks. That's the simple nature of monetary policy. We have an environment where there might be this increasing risks on both sides. Inflation may go higher and growth may be lower as a result of these trade tariffs. That's the stagflationary shock that is very difficult to deal with from a central banking perspective. I think the key area to focus on right now is inflation expectations. Because so long as inflation expectations are anchored, central banks can look through any inflationary pressure that may be considered as transitory. I know that's a bad word in this environment, but they may be able to do so. If inflation expectations become unanchored, then central bankers will have a difficult time not reacting to higher inflation.
Let's sit on that central banker's dilemma just for a moment and the approach to it and how you communicate around it. So to Lisa's point, the Bank of Canada has been blunt about it. I would suggest that the ECB President Christine Lagarde has been equally blunt about it. Do you expect Chairman Powell to be as blunt next week in that news conference?
No, I think Fed Chair Powell will have to tap dance around policy uncertainty and its cousin, market volatility, because what we're seeing is essentially policy uncertainty weighing on business activity. The cost of waiting in this extremely volatile environment from a business perspective is very low. Businesses have no real reason to start acting, start investing in today's environment, nor have they reasons to start hiring. They're going to wait and see how policy develops. We're also seeing an environment where the first quarter GDP growth is likely to be lower, both on consumer spending that is softer and on imports front-running these tariffs. And then we have an environment where stock prices are under a tremendous degree of pressure. How will Powell react to all of those factors that are growth negative and stock market negative?
But what's different now than December was? Well, December was really wait and see. Now it's showing up in data and in surveys.
Yes.
He can respond or should be able to respond to hard, cold data, no?
Yes, but the recent view from policymakers at the Fed, including Powell, is that the economy is just fine today the way it is. That may be a misread on the state of the economy. I would argue that the economy is softening, that the labor market is softening, that consumer spending is softening in this environment of high interest rates and high prices, and therefore there should be some accommodation. The risk, as you well know, is that in 3 months' time, in 6 months' time, we'll likely start to see much more of these inflationary pressures, and that will force policymakers to pivot. A very reactionary Fed is subject to rapid pivots, and that is unfortunately going to be the case, I think, in the coming months.
Front page of the Wall Street Journal this morning has data from convenience stores saying Americans are still coming up for gas, but they're not buying Newports, they're not buying Doritos, they're not buying Twinkies. Is that the first to crack when it comes to consumers, these extras you maybe get?
I think so. I think we're seeing consumers being very cautious with regards to service sector activity. You were talking about vacation plans. The latest conference board reading on vacation plans over the next 6 months fell to a 3-year low. We also saw, and perhaps this was a bit of an artificial effect, but some weakness in airfare in the latest month of CPI data. That may also be an indication of softening travel demand. We are seeing essentially this bifurcation in consumer spending. Lower income individuals are much more judicious with their outlays. Higher income individuals are still spending a little bit more freely. But let's not forget that a big driver of consumer spending at the higher end of the income spectrum is wealth and stock prices. So if we start to see that policy uncertainty filter into market volatility and put downward pressure on stock prices, that could be a risk for these higher income individuals, both on the confidence front and from a wealth effect front.
We don't have to speculate too much about this. The airlines have told us it's happening. Delta came out first, American followed up, no one denied it. They said starting in mid-February, it started.
And it started as a result of uncertainty at businesses. They're seeing it among businesses that do business with the government, from the government, but it went beyond that. And they're saying they got the what? Parade of horribles. I love that from Delta CEO Ed Bastian.
Greg Daco of EY. Greg, it's good to see you. Thank you, sir. Equities just turning positive on the S&P 500 with an update on stories elsewhere. Let's get to your Bloomberg brief with a parade of horribles with Danny Berger. Hey, Danny.
Thanks for that, John. President Trump's Middle East envoy, Steve Witkoff, is headed to Russia this week to present a 30-day ceasefire proposal to President Vladimir Putin. The U.S. reached the deal with Ukraine in talks in Saudi Arabia. Bloomberg reports that Putin will probably agree to the truce eventually, but will want his own concessions made first. The Federal Trade Commission is moving ahead with an antitrust probe of Microsoft that was opened in the final days of the Biden administration. Bloomberg has learned that the FTC is scrutinizing Microsoft's decision to slash funding on its own AI projects after striking a deal with OpenAI, which could be perceived as hurting competition. Here's one away from the parade of horribles. Some good news from Deutsche Bank, increasing its bonus pool to the largest amount in a decade. The boost comes after a surge in deals and trading last year. Deutsche Bank awarded $2.7 billion in variable compensation to staff for their work last year. That's a 26% increase compared to the prior year. And that's your brief, John.
Hey, Danny, thank you. That stock having a wonderful run so far in 2025, that's for sure. More from Danny in about 30 minutes' time. Up next on the programme, tit for tat, tariffs.
As you know, we're going to be doing reciprocal tariffs. There are some cases where they're a little beyond reciprocal because, we've been abused for a long time. April 2nd is going to be a very big day for the United States of America.
We're anticipating that very big day. We'll catch up with Julian Mitchell of Barclays next. Had a few downgrades in the last few days. Over the past week, HSBC downgrading US equities to neutral, Citi doing the same thing. Goldman Sachs came out and cut their forecast on the S&P 500. We spoke to the biggest bull on the street early this hour, John Stoltzfus of Oppenheimer, with a price target north of 7K. He is still bullish. He says you want to layer in here. That's the bullish view. At the moment, equities, dare I say, and everything's relative, on the edge of snoozy over the last 24 hours. That could change.
Oh, you're going to jinx it.
That could change. Of course it could change.
Honestly, the fact that it's snoozy, though, can I just say, is actually news in and of itself. Because yesterday, everyone was getting really excited. The bounce is coming. We didn't see a decline. So there's a question of can it continue? And if it doesn't, I think that's actually going to be really interesting.
I'm not trying to sell it. Just trying to say as it is. Equity futures right now in the S&P positive by close to 1/10%. Under surveillance this morning, tit for tat tariffs.
As you know, we're going to be doing reciprocal tariffs. So whatever they charge us, we're charging them. Nobody can complain about that. I don't know why people get upset about that because there's nothing more fair than that. There are some cases where they're a little beyond reciprocal because, we've been abused for a long time as a country. I'll always have flexibility, but there will be very little flexibility once we start. April 2nd is going to be a very big day for the United States of America.
So here's the latest this morning. President Trump promising reciprocal tariffs against the European Union after it issued countermeasures against his 25% steel and aluminum levies. The measure weighing on the outlook for industrials. Julian Mitchell of Barclays writing, much of multi-industrials could see some negative impact on margins and perhaps profit for at least a quarter or two before offsets ramp up. Julian joins us now for more. Julian, welcome to the programme. Let's get straight into it. That last line, when you think about offsets, what kind of offsets are available to them?
Hi, good morning. Yes, so I think there's a couple of main tools that CEOs will try and use in order to offset the effect of higher costs, whether it's direct raw materials or broader imported components. I think the first one, and they've all highlighted this as being a very well-developed muscle, if you like, now, is push-up price. This sector, US multi-industry companies, had about double-digit, low-teens price increases in 2022. That's the last time we had a spike in inflation of raw materials and components. Ending 2024, that price inflation for this sector had eased to around a low single-digit rate. I think all these companies are primed with their finger over the button to push up prices again very, very quickly in early April as needed. And they will expect that all their distributor and channel partners will follow suit as well. So that's the first very rapid response. I think beyond that, you may see some movement in sourcing of components and raw materials as well. But I would not expect probably wholesale changes to the manufacturing footprint of these companies. I think they like to use shorter term measures, delay their own investments because of all the uncertainty, and then perhaps evaluate broader manufacturing footprint changes later on, perhaps next year.
Julian, I'd love to just develop that, this idea of how long before people start moving production back to the United States, which is the outset of, which is the goal, the stated goal of a lot of these tariffs. Are you saying that that won't happen in the vast majority of cases because they'll take a short-term view, expecting some of these tariffs to either change or be lifted at some point in the near future?
Yes, that's exactly right. Yes. I know for decades, and we saw a resumption of this in Mr. Trump's first term, and of course around the COVID supply chain issues, there's always this talk about U.S. onshoring, reshoring, that type of thing. I think it's extremely unlikely that most large manufacturing companies will do more manufacturing in the U.S. It's very expensive to do it. Labor's tight. Skilled labor for certain manufacturing jobs is even tighter. And so it's very difficult then for business owners to pursue that path if it's more difficult and more expensive. And I think one effect that you'll see from higher tariffs on imported goods will also be, of course, that domestically produced goods, the price of those will go up. So I would imagine you'll quickly see the cost delta between imported goods and domestically produced goods. That delta might be very wide on April 2nd, and then I would assume that within a month, it's probably very narrow again.
Julian, how much is this giving a carte blanche to a lot of these companies to raise prices significantly, even beyond what some of the tariffs are, and raise revenue that way?
Yeah, so I think that they absolutely will look at a minimum to cover their dollar profits in terms of offsetting the higher costs. Many of them, I think, will also look to preserve percentage operating margins. And some of them, like we saw in 2022, when they were getting double-digit price increases, they could even see a big margin uplift. So I think it really depends on the company, their industry, the competitive landscape, how that feeds into pricing power. But absolutely, I think many companies will see this as some opportunity, perhaps, to even push operating margins up. And that's what happened 3 years ago.
Julian, what you're saying is completely different than what the administration is saying, which is that the stick approach of tariffs will bring manufacturing back to the United States. If you're saying that's not enough for companies, would a carrot like a 15% corporate tax rate do the trick?
It's possible, but look, we have a lot of experience of these types of carrot and stick moves from, the period of 2016 to 2020. You saw then a mix of corporate tax cuts, higher tariffs put on imported goods from China. So we've seen many similar measures before 7 or 8 years ago, and we did not see a pickup in U.S. onshoring or a pickup in U.S. manufacturing. If you look at recent years, things like purchasing managers' indices have been under pressure. Manufacturing employment in terms of jobs added in the U.S. has been under pressure. When you look at basic import-export data, an economy that's onshoring manufacturing should see a narrowing, one would think, of the trade deficit because your imports start to move up. Your imports start to move down, your exports start to move up, the trade deficit would narrow. That's the opposite of what we've seen. And most recently, obviously, with the January trade data, you saw that opposite still playing out, very high imports and muted exports.
Hey, Julian, we've got to leave it there. Appreciate the update from you. Julian Mitchell there of Barclays on some of the industrials and how they handle these tariffs. The offsets, that's the word we're all interested in, how the costs will be distributed. Who's going to absorb these costs? Are they going to have to take it on margin? Can they pass it on? All those things we need to figure out over the next few months.
And ultimately, it just depends how much people want their products, right? If you are an iPhone, I was going to say an iPhone producer, but at the same time, Apple's kind of gotten hit on the head. I'm just thinking about what addictive devices in my home might end up being able to have some pricing power.
It also depends where you're producing them. Walmart goes to the Chinese and said, you're going to have to eat some of this. And they're saying, actually, we're not. It's on you.
This is not predictable at all. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with Megan Horneman of Verdence Capital Advisors, the former Trump White House trade official Katie Kalutkiewicz, the former New York Fed President Bill Dudley, and Dirk of Citi. Look out for Dirk at the end of the next hour. Downgrading US equities recently and going into China. We'll get his thoughts in the next hour from New York City. This is Bloomberg.
We're still tactically quite cautious on equities overall, particularly, of course, in the US. This is the kind of time where you need to update your framework, your indicators pretty much on an hourly basis.
We're not seeing any signs of significant nervousness. There is a lot of demand for alternative assets.
The conditions are ripe for at least a relief rally.
If there's no recession, a market down 10% tends to have pretty positive returns in the 12-month forward.
Investors need to understand how much tolerance do they have for short-term mistakes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with stocks just about steady on the S&P 500. Anywhere between unchanged to negative 0.1%. We'll see if that changes. On the Nasdaq 100, we're down about 0.2%. The main event later on this morning is the economic data at 8:30 Eastern Time. Both PPI, another read on inflation following a softer CPI yesterday, and jobless claims. Will the uncertainty around policy begin to bleed into the hard data and speak to some weakness in the labour market data? That data point coming up a little bit later. Coming up later too, this conversation with the Commerce Secretary, Howard Lutnick, at 8 a.m. Eastern Time, 60 minutes from now on Trade.
There's going to be a real question here of what kind of check the White House is looking at to understand just whether they still have some leeway to continue with this negotiating process. In other words, how much are they watching? If they're not watching Wall Street, if they're watching maybe Main Street, at what point do they take some of these indicators, these economic indicators, as a warning signal that they got to speed up this process?
Well, that's why PPI is going to be interesting. Paul Donovan of UBS talking about the fact that pricing power is important to determining how much of what he calls a trade tax passed along to the supply chain. So we'll get a little bit of that after we hear from Secretary Lutnick. And for him, most important today is going to be that meeting he's going to have in Washington, D.C. with the Premier of Ontario, the Canadian Finance Minister. One, the current tit for tat when it comes to the tariffs. Two, April 2nd reciprocal. Three, renegotiating USMCA.
There's a phrase we've heard repeatedly from a lot of companies, a lot of policymakers, a lot of business leaders: wait and see, wait and see. Torsten Slock of Apollo calling it the wait-and-see economy, and writing this morning. In a wait-and-see economy, it eventually leads to a slowdown in the hard data. Markets should prepare for that scenario. Are we prepared for that scenario?
The markets are starting to sniff that out. How much they can actually price that in is a matter of debate between the bond market and the stock market. And frankly, what the response mechanism from the Federal Reserve is another aspect of that. In that Torsten Slock note, he talked about the fact that small businesses account for 80% of the employment in the United States. They are signaling in the NFIB survey that their confidence is dropping, and they expect to have to raise prices at the same time that they're maybe remaining on hold and have a high level of uncertainty. This is a theme. At what point is it becoming sticky? And that, I think, is why the economic data becomes more important.
Small business confidence at a 4-month low early this week. Equity futures just about negative. We're down by not even 0.1%. Coming up this hour, we'll catch up with Megan Horneman at Verdence Capital Advisors as U.S. growth concerns grip Wall Street. The former Trump White House trade official Katie Kalutkiewicz on trade tensions, and Dirk of Citi on why he's downgrading U.S. equities. We begin this hour with stocks just about steady. Megan Horneman at Verdence Capital Advisors looking for more weakness, writing, we remain concerned about economic growth in the first half of 25. The consumer is the biggest threat as debt and higher prices are straining balance sheets. We expect this valuation correction in equities to continue. Megan joins us now for more. Megan, welcome to the program. As you know, a feature of this economy post-pandemic has been the resilient consumer backed up by a strong and powerful balance sheet. What's changed?
I think this started to change last year. We saw that the COVID-related stimulus has really been wound down from the consumer's perspective, and they were borrowing using credit cards. We also saw some statistics recently where the largest amount of Americans are pulling from their 401k just to fund spending. And now we're seeing that hit a wall. The uncertainty has just risen too much from an economic perspective, and they're just stretched. The delinquencies are rising as well. So we think this pullback in the consumer is healthy and warranted. And it's not too surprising to us given how much they've run really since the pandemic. Jamie Dimon at JP Morgan said this recently: I don't think the average American consumer who wakes up in the morning and goes to work changes what they're doing because they're reading about tariffs. You've pointed out that this started in the last 12 months. How important has the policy shift, the policy uncertainty been to the changes you're seeing? I think it's sped up that kind of consumer pullback. And I do think that the tariffs have impacted consumer confidence to a degree, but primarily because it's really created a lot of uncertainty around inflation expectations. And we've seen that in consumer data. You can look at the University of Michigan expectations for inflation. These have shot up significantly. So while consumers may not be following this tariff data, point to point every single day, just that threat of higher prices after they've already had to absorb higher prices for several years, that's combining with colliding with this really low consumer confidence.
When you look at all the data, what to you speaks the most in terms of volumes of what you really are looking for to see a slowdown in the consumer?
There's several things. Obviously, retail sales is a big thing, but we look also at some of these consumer confidence indicators. Historically, it may not have really happened so much in the past couple of years since the pandemic, but if you go back beyond the pandemic and just look at history, there's a tight correlation between weakness in consumer confidence and then how that correlates into future spending. And we've just seen confidence continue to deteriorate. We're looking at levels, if you go back to either the lead up to recessions or slowdowns in the economy, we're there from a confidence level. So we think this is going to correspond to some slowdown in spending the first half of this year.
Could this uncertainty push the U.S. into a recession?
We're walking a very fine line because we have seen that, you can see consumers kind of live in this feedback loop. So where it continues to be negative headline after negative headline, and then they just pull back spending similar to how businesses do. Let's just wait and see. And the problem with that is the consumers make up 70% of U.S. GDP. So if the consumer pulls back, that does impact GDP.
So what's the defense trade here, Megan? Is it to buy bonds?
Well, not a couple weeks ago, no. And I think the defense right now, we did see yields come back down. They are now widening out a bit, but not really in the longer term part of the curve that warrants you that risk or rewards you for that risk you're taking from an inflation perspective and then from an issuance perspective, specifically here in the U.S. Instead, what we're looking at in our portfolios, and we came into this year, is make sure you have dry powder to put to work. Also, don't be afraid to invest in things that look like those valuations are rewarding you for that risk. It's okay to be a little ahead on this, but when you're looking at some of the areas of the equity market that are down close to bear market territory, like small and mid-cap stocks, if you can withstand short-term volatility and have a long-term time frame, then these areas you should start piecing away at.
There's a question about what we should be pricing in. And Julian Emanuel of Evercore ISI put out a report that I thought was really interesting, talking about how the market right now seems to be pricing in more of a stagflationary-like scenario, which could mean a 10% downside to equities. If there were truly to sniff out recession, it would be some 40% drawdown or something of that nature. Do you have a sense of what that looks like? Do you agree with that assessment?
I think that's a little bearish in our opinion. I think this is a short-term recalibration or reassessment of what we're looking at from an inflation standpoint, from an interest rate standpoint. Don't forget that investors have been looking for continuous Fed rate cuts. And I think what you're realizing now is the Fed can't come in and save the day like they have in the past. That Fed put is something we won't see. They don't have that flexibility. So I think you're seeing this kind of, from a valuation perspective, reassessing what we can expect from interest rate cuts, what we can expect from the earnings environment. And obviously the earnings environment right now is at risk because of the tariff, back and forth. But I think this is, anybody who came into this year not expecting volatility to pick up, I think came into this year very complacent. We did not. We knew that we've had the Trump administration before. We know the playbook. He's campaigned on this. We know he's a disruptor. He was coming in to disrupt markets. He's just doing this, I think, much quicker than people expected. So he's pulling a lot of this uncertainty into the first quarter of this year. I think as you get into the summer, a lot of this will clear up. And then when we get into the second half of this year, the main focus is going to be on the Tax Cuts and Jobs Act, which is a benefit for the market. So again, first quarter of this year, even first half of this year, expect a lot of volatility, but don't be afraid to look at your portfolios for the long run and invest in those areas that can reward you for the risk that's there.
Coming into this year, Megan, people said that there was going to be at least a Trump put on the stock market, if not maybe a Fed put in the same kind of way, due to the stickiness of inflation. You're saying that not only is there not a Fed put, but the Trump put isn't there for now. How how much of your bet is hinging on the idea that the Trump put essentially comes on later in the year with policies that are a little bit more friendly to Wall Street?
Well, when it comes to politics and when it comes to, any president that sits in the office, we're not looking at portfolios for the long run over what might happen over the next 6 months. We're looking at opportunities for the long run that are looking at the fundamentals of the U.S. economy. And even though the U.S. economy right now is weak, the long-term fundamentals of this economy are still very strong, regardless of who sits in the White House, regardless of what policies are there right now. We know that a lot of these are negotiating tactics. So it's going to seem loud. It's going to be a lot in the headline news. This is going to spook investors. But for the long run, we will get through this. We think that the Trump put that you called it, I don't think that Trump's really looking specifically at what's happening on a daily basis in the equity markets for now. But don't think that's not going to bother him forever. If this continues into the second half of this year, we may see some softening in rhetoric, and I don't know exactly what that may be right now, but he is looking forward to getting that Tax Cuts and Jobs Act extended, as well as, don't forget, we'll be coming into midterm elections before we know it.
Megan, just before you go, I just wanted to address what I think is quickly becoming a dilemma for capital allocators, and that's how the bond market might behave. What I take away from you is nothing too dramatic here, potentially a story of two halves for 2025, but the ability to absorb shocks, the capacity to absorb shocks in this economy has been reduced over the last 12 months. And with that in mind, I want to think about the events elsewhere. Do you think the events elsewhere, particularly in Germany, maybe reduce the risk mitigation characteristic of bonds here in the United States? Yesterday was curious to me. I've seen other days like this over the last week where bonds haven't offered me that ballast when equities have started to move down, when we've seen that risk-off story. At other times it's worked, other times it hasn't. It hasn't been reliable. Megan, what's going on there, and how do you think about that going through the first half?
So we have to look at bonds as a whole and take out the tariffs. And right now, bonds are reacting on the threat of inflation. So you're seeing some of the long end of the curve globally start to rise. And there can be correlations when you see moves in global interest rates. So we saw that, for example, yesterday here in the U.S. When it comes to using bonds as a safe haven, you have to be very careful that this is the first time in a very long time that we've had to be looking as an asset allocator, that we've had to consider the fact that long-term bonds may not be the hedge because of the inflation risk. These are things we've typically used when you're heading for an economic slowdown as a way to hedge against your equity exposure. But that long end of the curve, not only here in the U.S., but globally, is being impacted by the inflation expectations. So you can still use bonds as a hedge. Just stay defensive. Right now, cash and short-term bonds are earning you a nice yields we haven't seen in a while. So there's no reason that you need to extend duration out significantly to really hedge your portfolios. You can balance that out in a short, intermediate term part of the curve.
Megan, appreciate the clarity. As always, it's good to catch up. Megan Horneman there of Verdence Capital Advisors. Just finishing on the bond market there. We've seen this a few days now, haven't we? The bond market behaving in an unpredictable way.
The more jumpy the market becomes on the stock side, bonds are also selling off, and you're seeing that with yields continuing to climb for yet another day in the United States. Raises a question about why would you invest in long-term bonds if you can get a nearly similar yield, at least in the short term of the curve, and that's what you're here.
Equity futures this morning down about 1/10% now. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Alibaba has released a new AI model, which it claims can read emotions. The R1 Omni is said to be capable of inferring a person's emotional state from a video and also describe their clothes and environment. It's free for download on the AI development platform Hugging Face. Dollar General shares in the pre-market trade up 5%. It forecast sales with a top end that was higher than estimates. It also announced plans to close 96 of its namesake stores and 45 pop shelf stores. Dollar General said that consumables like groceries are now accounting for a higher proportion of sales. The Thai hospitality group that owns hotels featured in HBO's The White Lotus is eyeing expansion into the U.S. Since the third season's premiere, direct online bookings for the resort have increased by 41% versus the same period last year. Minor International plans to expand to 1,000 hotels by 2030. And that's your brief. John.
Danny, thank you. Lisa, no spoilers. Just had to get that in really quickly.
Thank you so much, because I haven't seen it yet.
I know.
Okay, I haven't seen it yet either. There's only one person here who's seen it. So who's the story catering to?
I'm not going to spoil it. I'm not going to spoil it.
Yeah, but he doesn't spoil. Okay. You come out and always tell us the end.
I gang up always. It was once. Sorry.
Don't do it again. All right?
Let's
Season
move on.
1 was better than 2. Two's better than three. Just going to throw that out there, all right? Up next on the programme, countering countermeasures.
European Union's been very tough. And it's our turn, too. You know, we get a turn at that also.
Season 2 ruined Sicily. That's the problem.
But that was a better season.
Taormina was like this nice sleepy town 20 years ago. Now it's too busy. Anyway, let's talk about trade. Up next on the programme, the former Trump White House trade official Katie Kalutkiewicz joins us next from New York. This is Bloomberg. So later this morning, another read on inflation. We get PPI at 8:30 Eastern Time. You get jobless claims too, so look out for that. Going into it, your scores look like this. Equity futures on the S&P 500 negative by 0.2%, rolling over just a touch in the past 30 minutes or so. On the Nasdaq 100, we're down by 0.3. Under surveillance this morning, we're countering countermeasures.
When you put more tariffs on the EU, will you respond to their retaliation?
Oh, of course I'm going to respond.
You will retaliate.
The problem is our country didn't respond. Look, the EU was set up in order to take advantage of the United States. European Union's been very tough. And it's our turn, too. You know, we get a turn at that also.
So here's the latest this morning. President Donald Trump saying the United States will respond to EU countermeasures against his 25% tariff on steel and aluminum, but not specifying what measures he would take. This as Canada strikes back with its own 25% tariffs on over $20 billion of American goods. Joining us now from the nation's capital, Tyler Kendall. Tyler, I'm losing track of who's putting countermeasures on who and who started what. Tyler, are you keeping track of this?
Yes, John, good morning. It is a lot to keep track of, but one thing that we do know from the White House when they say they are going to respond, one through line that we've been noticing is that when they say there will be retaliatory measures against the retaliatory measures, that has to do with rolling those calculations in to those reciprocal tariffs that we are expecting on April 2nd. That is where senior administration officials keep pointing us to. And another headline out of the Oval Office yesterday, President Trump saying that once that date rolls around, there is going to be very little flexibility. And we have to remember what these countries are negotiating against. Perhaps on Canada, it started to be about border policies yesterday. It officially became about national security concerns when President Trump invoked Section 232 for the steel and aluminum tariffs. But broadly speaking, this administration is pushing that this is about rebalancing trade and lowering those tariff barriers. And President Trump seems to have a special ire for each of these countries, whether that is Canadian lumber or dairy or EU autos and pharmaceuticals. But importantly, John, we have to keep in mind in the background of all of this, the White House is pushing that this is about longer term growth, which goes hand in hand with their fiscal agenda. That is why they say that they need to have these tariffs in here to get that revenue raising a revenue in order to balance that trade, those tax cuts that this White House would really like to see pushed through.
The main event about 2 weeks away, reciprocal tariffs just around the corner. Tyler Kendall there in Washington, D.C. Tyler, thank you. That's the issue we've all got. Is it about revenue raising? Is it about market access? Is it about the border, fentanyl, immigration? Is it about a personal dispute between two leaders? What is it about?
The problem is if you try to find consistency, if it's revenue raising, then there should be a bit of a concern with any kind of economic downshift, right? If you have a slower growth environment, you're going to be bringing in fewer revenues from taxes. So it's hard to wrap your head around in any given day, but I love the idea of can you keep track? And when you say the big event, I'm not sure what you're talking about. Is it the government shutdown?
April 2nd.
Is it April 2nd? Could it be
tariffs.
Reciprocal tariffs? Is it going to be, I mean, really, there are a lot of main events.
Their words, not mine. They say it's going to be the big one.
I know.
The big one still to come next month.
Spoiler.
Joining us now, their spoiler, the former Trump White House trade official, Katie Kalutkiewicz. Katie, welcome to the programme. Katie, really hard question. In 3 weeks from now, where do you think we'll be?
That is a really hard question. Thank you for asking it, and thank you for having me. I think we're going to have some more tariffs, though I think in reality, as you've probably heard from previous guests, the implementation of a reciprocal tariff arrangement with the rest of the world is quite difficult to accommodate and implement. The United States, of course, like every country, has thousands and thousands of goods that enter under various tariff rates from over 100 countries. So I think what we're going to see is the president really focus in on some of what he considers to be the worst offenders. And unfortunately for some of our allies, like the ones you were just discussing, I think they're right in the crosshairs.
But when it comes to the U.S. weighted tariff rate, it's 1.5%. The European Union is 1.6%. Japan's 1.35%. Who was this administration really going after?
It's a great question because, of course, you're exactly right. Our average tariff rates are quite low, but the president has been fairly explicit. And frankly, the United States has been explicit for a long time that in the economies that you've mentioned, it's the non-tariff barriers that are really a concern. You know, in the European Union, for example, we have difficulty selling our agricultural goods because of regulatory barriers. In Japan, we have issues selling cars. Despite a 0% tariff rate on automotives, we struggle to sell our cars there because of their regulatory barriers. So you're right to focus on the tariffs. I do think that we will see some tit for tat on tariff rates, even if it's a small amount. But the president has directed his government agencies to calculate the harm of these non-tariff barriers, ostensibly to come up with a corresponding tariff rate.
Katie, if you're an investor, on April 2nd, do you see the actual tariffs or you just see basically the tariffs get publicized and what they plan to do?
I think we're going to see a range of actions. If you go back to the first document that outlines the president's goal here, the America First Trade Policy Memo, which he issued on day one of his administration, you will see directions to a wide range of agencies, which have a wide range of tools. I think we will see a number of new investigations. The president has, of course, already launched some with respect to timber, lumber, and copper. I suspect he will be looking at additional strategic sectors. Semiconductors and cars come to mind, as do pharmaceuticals. I suspect he'll use the 301 authority, which is what launched his first trade war with China, to look into some of these more pernicious barriers. And then I think we may see, exactly as you described, new tariffs that respond to the differential tariff rates in certain economies.
Kate, you were in the previous Trump administration. How different is this Trump administration's approach to trade, to tariffs, than when you were in the White House?
You know, what strikes me most is a little bit about what you were talking about previously, which is just it's the speed with which some of these things are coming. The question about the motivation. I mean, as you said, the president has talked about tariffs in response for fentanyl, in response for the border, in response for reciprocity. I mean, they are coming so fast that I think even our trading partners are trying to catch up. They're trying to understand, what will this president respond to? Is it a deal, as we all had anticipated and come to know in the first term? Or is that simply a fool's errand? And I think for our allies in particular, they're really struggling first with coming with olive branches, trying to offer a deal. Second, to try to match the president, which, as we saw, did not work well for Canada. I fear it will not work well for Europe. And then maybe a bit of recognition that this is the new reality and trying to settle in and bear down. It is different in that respect because it does not seem, at least at the immediate term, the president is interested in a deal right now.
Kate, appreciate your perspective on things. Difficult questions to answer. Where are we going to be in 3 weeks' time? Kate Kalutkiewicz there, the former White House trade official in the Trump administration in the first term. So, Lisa, I would say speed and sequencing. To Kate's point, it's moved really, really quickly this time around. The sequencing, of course, is different. They've started with trade. Last time they started with taxes. I think there's another big difference as well. This 4-year gap between the first term and the second term, the president has had time to think. Had time to think about what he wants to do. He also understands the levers of government in a way that he didn't before coming into the White House. And he's moving much more quickly because of those things, I think. They all just line up. It all just stacks up perfectly for him to hit the ground running in a way that he has done. And
he says that he has a plan, and the entire administration gives us the longer-term trajectory. What Kate was saying there, though, her last point was really telling, which is it doesn't seem like he's interested in making a deal right now, which makes it that much more complicated.
He's in negotiating mode. You have to think, though, 3 pillars of the Trump administration. It's going to be trade, low regulation, tax cuts. How do you do this all when you can't control the timing of at least one of the big ones?
Up next on the programme, we'll catch up with the former New York Fed President Bill Dudley on why he thinks markets are underestimating tariff risks. Do you remember when Lisa ruined Shogun?
Oh my God.
I do, because I never
Is it
watched Shogun.
really? You've got nothing else to talk about.
Brutal.
Really, there's enough going on in this world.
That was a tough day.
I didn't end up watching it because I just thought, what a waste of time.
Lisa basically told you the ending.
I think I'm gone now. See you later.
Equity futures on the S&P. You'll be missed. Don't go anywhere. Equity futures on the S&P, negative by about 0.2%. Lisa will be missed because later on this morning, we'll have some economic data, PPI, in about an hour from now. Jobless claims as well in 30 minutes' time. Don't miss this conversation. We'll catch up with the Commerce Secretary, Howard Lutnick, at 8 a.m. Eastern Time. That's 30 minutes away. Don't miss it. We're 2 hours away from the opening bell. Let's get you some morning movers. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Intel. Finally, a new CEO over there, and the market likes it. Shares are up 11.5%. Lip Bhutan will be at the helm, and his strategy is to stick with the current plan of making chips for other companies. Yes, it has been a costly endeavor and one that even led to the ouster of his predecessor, but he thinks he can execute, and so does the street. BofA upgraded the stock from underperformed to neutral, and a number of other analysts are reacting positively. Next up, we have Adobe shares. Those are moving in the other direction, down 5%, after the company behind Photoshop gave an outlook for the current quarter that failed to excite investors at a time when they're looking for progress from Adobe on monetizing all those investments they've made into generative AI, but it's not happening as soon as they'd like. And last up, we have shares of American Eagle. Those are plunging 9.7% after issuing weaker than expected guidance for the year ahead and signaling that tariffs are going to hit margins. Plus, it's the latest company warning us that the consumer is pulling back. John?
Yahara, it's another one. We've heard from a few. Appreciate it. More from Yahara in the next hour or so. 3 of the names to watch going into the opening bell. 2 hours away. On our radar this morning, the US budget deficit hitting a record in February. The biggest contributors to the continued widening, Medicare costs and servicing government debt.
So this is a big problem because they are trying to, one, bring down the deficit and then also make way and room for the $4.5 trillion of extending TCJA and maybe adding on some of these taxes provisions that the president talked about on the campaign trail. And this number just makes it that much harder because guess what? You can't really control the interest. And also, the president says he's not cutting Medicare.
If this market were pricing in the complete package of this White House, of potentially what could amount to more than $5 trillion of tax, of basically deficit increases over the next 10 years at the same time as tariffs, yes, with the tax cuts involved, how would that mix look like in markets? Would it be a benign outlook? Would it give a boost to the consumer? Yes, probably. But how much would it also kick up the long end of the yield curve in a way that I know Scott Bassett wouldn't want to see?
Well, from a market perspective, arguably that was the story of November, December. And then all of a sudden things changed when we started 2025.
And the real question now is, if they do make traction in the Senate, in the House, how much does the market start to reprice that, or have some of the other developments taken that off the table for now when we're talking about whether or not the government will shut down tomorrow night?
Well, let's get to the shutdown, and I think that's going to be the main story for a lot of people. Before we even talk about taxes, we need to talk about this. Senator Chuck Schumer saying his party will block a GOP bill to avert a government shutdown on Saturday. Schumer urging Republicans to instead accept a Democratic plan to fund the government through April 11th. His view is quite simple. You don't have the votes. If you don't have the votes, you need to negotiate.
Right. So they want to have at least 24 hours, I believe, of this negotiation. What do you get in the end? Potentially, they will be able to have an amendment where they vote on and show politically we wanted something different that the Republicans are trying to push through. But if they hold the line and we go through a shutdown, everyone in Washington, D.C. will get blamed for this, the Democrats and the Republicans.
It's a really difficult moment for the Democrats to know how to finagle it. A lot of people are saying, look, we have to get on board because we don't want to shut down the economy right now, given all of the other potential risks out there. At the same time, it is a difficult moment for them to take a stand when they don't have the leverage.
Either the Democrats cave, or Republicans cave and come to the table, or the Democrats say, look, we're not going to deal with this mess because it's going to be too much blowback on us. And we need to find a more consistent message to go after the administration and the Republicans than just saying we're going to shut down the government.
Our favourite story will continue into the weekend. Can be sure of that. Wanted to fit this in, an important development. The FTC is moving ahead with an antitrust probe of Microsoft that was launched late in the Biden administration. The agency also walking back comments that it's not ready for a September trial examining Amazon's Prime subscription practices. How they regulate things and whether we can go through with a different regulator with a different regime, I think is the big topic for a lot of people, including the banks for that matter. We thought we'd have all of these mergers and acquisitions, a softer touch, a lighter touch down in Washington. Not seeing much sign of that so far.
You might get a softer touch, except when it comes to technology. And Andrew Ferguson, the new head of the FTC, kind of taking a playbook from Lina Khan. One of his first public remarks since taking the position back in February, he said investigating the tech sector is his highest priority. And guess what? You see that here right in the beginning, 7 weeks in.
I think a lot of advisors at a lot of banks will be watching that story pretty closely. Let's turn back to the trade story, tariffs. The former New York Fed President Bill Dudley saying Trump's tariffs will be worse than markets think, writing, markets seem to think that if the president won't stop the damage, the Fed will. I think they're too complacent. Bill joins us now for more. Bill, welcome to the programme, sir. Great piece. Let's talk about it. Why do you think they're too complacent?
I think the problem is that the tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold, waiting for more information. Trump administration is making the matter worse because not only are they putting tariffs in place that are much larger than they did during the first term, they're doing it in a very haphazard, irregular way, which is creating a lot of uncertainty. The decline in merger activity in the 4 months of this year is pretty striking. People expected merger activity to pick up with the Trump administration. It's actually gone down because nobody knows what the rules of the game are going to be in terms of relative prices for inputs, relative prices for exports. So people are very confused and people are just sitting on their hands.
Bill, as John was just saying, you wrote this line, markets seem to think that if the president won't stop the damage, the Federal Reserve will with rate cuts. Where do you think they have the political leverage to not cut rates at a time when they are seeing quite a bit of potential destruction to the U.S. economic outlook?
Well, it all depends on what happens to inflation, how high does it go, and two, does it get into inflation expectations? The inflation expectations are the key issue for the Fed. The second thing they're going to be focusing on, how much does the unemployment rate rise? It's not about job creation. It's about the unemployment rate. One thing that people don't really understand, I think, well, is the fact that we don't need a lot of job creation to keep the unemployment rate here because the growth rate of the labor force has collapsed with the Trump administration. We're deporting workers. The number of people coming over the borders has collapsed. The growth rate of the native-born population is really slow. So top speed for the U.S. economy in terms of keeping the unemployment rate where it is probably 50,000 payroll employment a month. And I think people think that 150, 200,000, if it slows to 50,000, the Fed's going to cut. I think that's wrong.
Bill, I understand the argument that the Fed put isn't exactly there, that the Fed is going to come in and cut rates in response to market turmoil. At the same time, there is an argument that some of the tariff-related inflationary forces are one-time price adjustments that will eventually come down, especially with a weakening economic outlook, and that they can look through that a bit more and place a bigger emphasis on the unemployment rate and other economic indicators. Do you push back against that?
Well, again, it depends on whether it gets into inflation expectations. The first Trump term, the tariff increases were relatively modest. It wasn't an inflation issue because inflation was running below the Fed's 2% objective. This time, the tariff increases are orders of magnitude larger, and it's happening at a time that inflation's been running well above the Fed's 2% objective for 4 years. So inflation expectations are the key. And one troubling indicator in that regard is what the University of Michigan household expectations survey showed last month for 5 to 10 year forward inflation expectations. It rose to 3.5%, the highest level since the 1990s. So if that is corroborated by other inflation expectations indicators, that's going to make it much more difficult for the Fed.
Bill, you're talking about the upcoming economic projections we're going to get from the Fed, and you say inflation will be increased, but the path for the unemployment rate won't change much as labor force growth slows along with hiring. Are you basically saying the Fed and their projections are going to almost pinpoint stagflation?
Well, I think they have to lower their growth estimates, given the uncertainty that the tariffs are causing and the fact that it makes real income for lower income households very much squeezed, and so they're not going to be able to spend very much. They have to raise inflation because the price level of a lot of these imported goods is going to go up pretty significantly. So I think that's sort of in the cards. I think what's going to surprise people is that they're not going to raise their unemployment rate trajectory very much. And I think that people maybe be surprised that they're not going to increase the number of rate cuts that they have in their forecast. Last time they had 2 rate cuts for 2025, and I think they'll keep it right there.
Bill, let's just talk about those forecasts. What is the approach to putting forecasts together? in a moment like this? How much of a conversation happens between individual policymakers?
Actually, with regard to the summary of economic projections, everyone sort of does their own. So this is not coordinated. You are allowed towards the end of the Federal Open Market Committee meeting to change your forecast based on what you've heard from others, but people rarely do that. So these things are really put into place before the meeting starts and hardly ever changed.
A lot of people expect the statement of economic projection not to really move that significantly, and if they do, for it to essentially be irrelevant because they don't know anything. Do you disagree? Do you think that it will be indicative of what kinds of scenario analysis individual members are doing and how much they're incorporating policy for their outlook?
I think the reason it matters is the fact that I think people are looking for the Fed to sort of come to the rescue of the economy by cutting rates. And you've seen that in the decline in 10-year Treasury note yields over the last few months. And I think the Fed's going to signal through the summary of economic projections and in Chairman Powell's press conference is that, no, we're sitting on our hands for the time being.
Bill Dudley with the latest. Great piece on Bloomberg Opinion. That Bloomberg column available on Bloomberg.com and on the Bloomberg terminal. Bill, thank you, sir. As always, the former New York Fed President, Bill Dudley, there on the Federal Reserve and whether that Fed put is alive and well.
And the answer is probably not as quickly as you think, because the unemployment rate probably won't go up for quite a while. And that's going to be the ultimate tell for them. You asked a question earlier this morning, I believe, to Greg Daco that I thought was really interesting. Do you think that the Federal Reserve will have the same leeway to be blunt the way that the ECB and the Bank of Canada have been in this dual kind of conflict about slowing growth and higher inflation? I think that'll be interesting to watch.
I am noticing some subtle shifts, though, since the news conference of November, December time. We shifted from we don't assume, speculate or guess to some people did assume, speculate and guess. And the recent speech actually addressed policy almost head on.
Yeah.
And I wonder if that's just the beginning of doing more of the same next week, and we'll see.
They kind of have to, because if they don't give some acknowledgement of policy that we've already gotten and of market reaction, remember, the markets are one of the main transmission mechanisms of their policy. Can they now say that market turmoil is irrelevant to their outlook and irrelevant to some of their inputs? No, they're going to have to address it on some level, and I think it will be interesting.
That news conference will be must-watch on March 19th. That is next Wednesday. We'll have live coverage of that for you right here on Bloomberg TV. We are looking at futures declining by a couple of tenths of 1% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The IEA has cut its oil consumption forecast due to a slower pace of deliveries and escalating trade tensions. The agency said that global oil demand is under pressure from escalating trade wars at the same time that an OPEC Plus is reviving output, threatening to deepen a supply surplus. The IEA predicts a surplus of 600,000 barrels a day through this year. OpenAI has asked the Trump administration to shield AI companies from state regulations if they voluntarily share their models with the federal government. The company argued that AI-related bills threaten to undercut the country's technological progress. And in sports, the Champions League quarterfinals are set after Real Madrid beat their Atletico rivals on penalties. They move on to face Arsenal, who took down PSG 9-3 aggregate across 2 matches in total. Elsewhere, Barcelona will face Dortmund and Bayern Munich will take on Inter Milan. The first leg games will begin the second week of April. And that's your brief, John.
April 8th, I believe. Thank you, Danny. Appreciate the update. No one around this table apart from me wants to talk about it, so I won't even bother. Up next on the programme.
Can I just say, this is like stacked. White Lotus, and now this.
I didn't put any of these stories anywhere. Maybe there's someone interested in the control room.
Yeah. Oh,
in
yeah.
Some of this.
Big time.
Yeah.
Mm-hmm.
Who likes European football?
Yeah.
Why,
Spoiler.
Why are you so angry about it? That's what I'm trying to figure out.
Well, you still tried to out me and, make
out you for anything.
Yeah, for spoiling.
You
it's
outed
okay.
yourself.
It's all right. Stocks are down. Okay, it's okay. Up next on the programme, US exceptionalism at risk.
US exceptionalism is over in our mind. Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears. It's still a tail risk.
We'll get the view of Citi in just a moment. Dirk Willett joining us in just a second after downgrading US equities in the past week and looking to China. That conversation up next. The economic data is just around the corner, 8:30 Eastern time, so about 43 minutes from now. And going into that, equity futures drifting down towards session lows, just slowly over the last hour or so. We're down by 0.4% on the S&P. On the Nasdaq 100, we're down by 0.6. Under surveillance this morning, US exceptionalism at risk.
US exceptionalism is over in our mind, but this is a decade-long. I mean, look at how much money came into the US. So I do think that the exceptionalism story is over. Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears. It's still a tail risk.
So here's the latest this morning. The S&P 500 on track for its fourth consecutive weekly decline as growth concerns put US exceptionalism at risk. Dirk of Citi writing, in the coming months, we expect US growth momentum to undershoot the rest of the world. We therefore downgrade US equities to neutral, upgrade China to overweight. Dirk joins us now for more. Dirk, good morning. Good to see you.
Good morning.
Let's start with the downgrade on the US side. Let's talk about why. Why?
I mean, we overall downgraded equities actually already in February from overweight to neutral. For us, it was just a question, what are the overweights, what are the underweights inside this more neutral stance, right? And I think for the US, the data will remain weak. I mean, it only has started, really. The data momentum usually is weak early in the year for many reasons. It tends to trough at around late April, May. You on top of that have actually poor seasonals for the S&P going into tax payment season. So early April is usually a bad time when there was a lot of capital gains in the previous year. And more importantly, I think a lot of the economic data, especially on the job market side, is only to come. I mean, our economist called the last job report the last good job report, and it wasn't a great job report, right? It had some weakness under the hood, but it was the last decent one because we expect 300,000 plus in terms of Doge numbers. We expect 70K from people who took the buyout in the government, and that will happen in May, maybe stretch into September. The market is forward-looking, but I'm not sure we are out right now forward-looking enough to look through all the weakness that is going to come in the economic data.
Can we just sit on that weakness? What kind of weakness are you expecting? Are you expecting recessionary conditions, just below trend growth? What are you expecting?
It's a slowdown, right? And we are not in the recession camp. Our GDP forecast for the year is just above 1%. And therefore, we are not predicting, for 20% pull down in the S&P, you need a recession, right? We are not expecting that. For us, it's a question, who is the leader coming out of this? And we just don't think it will be the US because, a couple of things happened, right? Where we are upgrading European growth, we are upgrading Chinese growth at the same time when US growth is subpar. So it's a relative bet more than saying it's a US recession call.
This is an important point, especially at a time where a lot of people have come on the show and said the weakening was already in place before some of the policy uncertainty. And that's an important issue at a time when potentially other countries are responding with stimulus, and I'm talking about China and Europe. Just how much is this call being driven by what's going on in China and to some extent in Europe, more than what uncertainty or negativity there is in the US?
Yeah. I mean, it's both, right? I mean, the reason, for example, the big German fiscal stimulus, I think you can see it as glass half full, glass half empty. Well, it's probably more glass half full, but if it hadn't come at exactly the same time where the US data is also slowing, people would not have bought as many euros as they did, right? So it came, the German stimulus came at the perfect time for that trade coinciding with a weaker US view. And similar in China. I mean, China has not hit us over the head the same way that Europe did in terms of big fiscal bazooka, but they also have done something under the hood. They're also doing stabilizing measures, and more importantly, President Xi actually wants the equity market to go up, right? So the Xi put is closer than the Trump put in a sense, and so we are upgrading GDP in China, and it's really interesting. The best performing equity markets this year are the ones with the biggest target on their back for tariffs, right? It's China, it's Europe, even Mexico and Canada tremendously outperformed the S&P. And I think the reason for that is it's the opposite from 2018. In 2018, the US outperformed and China obviously underperformed. And I think the main reason here is that in 2018, the US mostly targeted China. And if you just target one country, then that country underperforms and the US can source the imports from many other places. And so it's just not that bad for the US economy. If you target everyone, it's just more difficult for the US to manage through that. And for the other countries on the margin, maybe slightly easier in relative terms.
To that point, yesterday, Loonie was the best performing G10 currency against the dollar, which I thought was really interesting on a day when some of these trade concerns were heating up. Why China? Why not Europe?
It's a good question. I mean, the stories are similar in the sense in that we're upgrading growth numbers in both areas relative to the US, right? So you could say, okay, if it's mostly about that, why don't you go for Europe as well? And Europe has performed really well, and actually our European strategist caught the trade. So it's not that it's a very good question, basically. The reason why we picked China is really that we think eventually the AI story will come back. We think right now it's probably not the time to press it, but in the very big picture, it seems to me the top in the market is really only in when the AI story is over, and we don't think it's over yet. Now, the stock markets with AI assets are, of course, China and the US. Right? And so that's why we gravitated to China.
When it comes to China, though, there's an additional 20% tariffs added on Chinese goods into the United States, and they're not going away right now, and potentially they can get higher. Does that not concern you?
It is concerning, and that is obviously the main pushback to the call, right? Why do you pick something where tariffs could go up? What I would say is, one, we already had 20% tariffs, as you point out, and what happened is interesting. What happened is inflation expectations went up. Some stocks in the US that import a lot from China sold off, and Chinese equities are broadly speaking at the highs. So you can see how the market has taken the tariff so far. Now, clearly that could change going forward, and there is tariff risk. But remember, we have it as part of the neutral equity allocation, where on the other side we are short Japan. My guess is if tariffs come aggressively, Japan would not be spared, and so in the end, it's a bit of a hedge too. But I must say it's amazing how little happened so far given the tariffs we've seen.
That's the equity picture. Can we just finish on bonds? What are you meant to do with the bond allocation at the moment? What do treasuries do in a portfolio for you? What are they there for?
And there we also unwound earlier the US exceptionalism trade. The US exceptionalism trade was really treasuries will underperform because that's where the strong growth is, that's where yields go up a lot, and bonds and so forth outperform, right? We unwound that. We got a bit lucky and did it before the German big sell-off. And so at this stage, the trade we have is we're still underweight Japan, because I think that story will keep playing out, and our overweight at this stage is the UK. So the UK doesn't have the same fiscal issues as the US, as Germany, and is also a bit of a laggard. We like to receive, but we prefer to not receive in the US because the Fed is just hemmed in by the inflation picture. Instead, we want to receive in places that have been lagging in the interest rate cycle. So for us, that is the UK of the bigger markets, but we also received in Mexico, received in Australia. We love Turkey. So there are a bunch of things where we think they're better receivers, but we're trading it from the receiving side. So we prefer long bonds and short bonds, just not necessarily in the US.
Interesting. Thoughtful stuff there, Dirk. Appreciate it, sir. Thank you. Dirk Willer there of Citi, just on the bond market, trying to figure out where to be, where not to be, and why.
And a reversal, essentially, of the Trump trade from last year. And that's an interesting one at a time where a lot of people aren't sure how to play. Deficits, tariffs, growth, it's confusing.
We've totally rewritten the post-election playbook in financial markets across all asset classes. Coming up shortly, in the next hour of Bloomberg Surveillance, Tracie McMillion of Wells Fargo, Nela Richardson of ADP, Cayla Seder of State Street, and a conversation with the Commerce Secretary Howard Lutnick coming right up from New York City. This is Bloomberg.
We've got a deteriorating fiscal situation here, and slow economic growth and tariffs will only make it worse.
We don't know what the pass-through of expected and actual tariffs.
What the market is playing now, in particularly the last week and a half, is increasingly recession fears.
The uncertainty is the more immediate threat, and I think it's more likely that we'll come out of this with just a slowdown.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and here's the price action. Equity futures negative by 0.25% on the S&P 500. On the Nasdaq, we're down by 0.4. On the main event this hour, 30 minutes away, the economic data. Look out for PPI, another read on inflation in America. Look out for jobless claims. How is the hard data? What is the labor market picture right now as we confront the prospect of more trade tariffs? We'll be catching up in just a moment with the Commerce Secretary, Howard Lutnick. Howard Lutnick, just around the corner.
And it comes at a time when we do get these dueling tensions in the market, and a dueling tension that we see in the data coming up, potentially where you could see inflation stickier while you have unemployment, or at least jobless claims ticking back up. That is the expectation. How does Howard Lutnick, the Commerce Secretary, respond to concerns in markets that they say are okay with them? A disturbance, a detox, as long as they get to the ultimate place. At what point does it become a concern?
So he's got to meet the Canadians a little bit later, and the objective of that, according to the Commerce Secretary, is to bring down the temperature on things. Might have to bring down the temperature on things between the United States and Europe as well. The President of the United States posting on social media just moments ago, the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world. That post coming just moments ago.
He's saying that because they have a, quote, nasty 50% tariff on whiskey. He says if this tariff is not removed immediately, the U.S. will shortly place a 200% tariff on all wines, champagne, and alcoholic products coming out of France and other EU-represented countries. The temperature is just going up. You have to think this must be negotiating mode for what he calls the big day, which is April 2nd, but it's uncertain and it's frenetic.
It's lunchtime in Paris, France, and I think the president just turned to his assistants and said, 1-800 Donald Trump, please. The president's on line one.
So this, to me, is a real question about what the ultimate goal is. Is this the negotiating period ahead of April 2nd where they try to get things in stone and kind of get better leverage before that? Kalutkiewicz, who was on earlier, who was part of the Trump administration 1.0, said that this is different because it is unclear what the goals are and what deal this president wants to strike. That is ongoing when you get truths like this.
This is for sure a maximalist approach when it comes to President of the United States and tariffs. And the issue the market is having and digesting is this is only one part of the entire Trump agenda. Deregulation, not really completely priced in yet, and we don't have the extension of the tax cuts yet, or more tax cuts added on top of that.
So honestly, at this point, what I'm looking for is how much does the market start to say the uncertainty in and of itself is going to become a feature and not a bug? And do we get some resolution on April 2nd, or does this just prolong that uncertainty as we continue with negotiations?
Some important economic data coming up as well at 8:30 Eastern Time. We need to talk about PPI after seeing CPI a little bit earlier in the week. This tees up the Federal Reserve's meeting next week. And as we've talked about extensively, they've got to put out some forecasts on March 19th. It's going to be so difficult to put out those forecasts and then walk into a news conference, Chairman Powell, face down reporters, question after question about policy and what it means for the outlook.
You know, Bill Dudley put it really well, and formerly of the New York Fed. I thought his comment on why it is important to watch the statement of economic projections was telling. It gives you a sense of their reaction function, of the idea of if they expect the idea of inflation coming up and you get some sort of slowdown in growth, do they, on the margins, expect to cut rates, or do they hold firm and try to counter inflation to a greater degree?
This is the concern for higher tariffs for a lot of people. It's both, it could be inflationary, even if it's just one-time price hike, which Scott Besson has talked a lot about as recently as the Economic Club of New York, but also hurting of growth, meaning Dudley's talking about the fact that you could see a dot plot that kind of insinuates we might have stagflation coming to America.
And this is something that central banks around the world have been grappling with. We heard that from the ECB, from Christine Lagarde. Yesterday, we heard from the Bank of Canada Governor Tiff Macklem, where he did lower rates by 25 basis points, the bank did, but indicated it might be the last and it might be kind of tricky going forward, saying the trade battle between the U.S. and Canada is a new crisis. And that right now there is pervasive uncertainty and the path forward might be tricky as they face off with the potential for inflation ticking up and growth ticking down.
Let's bring in Tracie McMillion into the conversation. She joins us from Wells Fargo. Tracie, welcome to the programme. Lots of important economic data later this morning, but just set the stage from your perspective. What this trade story means for you personally and for the team, and how you're approaching markets with that in mind.
Sure. So obviously the tariff comments and the tariff policy on again, off again is impacting the sentiment of consumers. So we're looking at it from that perspective. At this point, this is not setting up like a typical recessionary period because it's being preceded by the weaker sentiment from consumers and not being preceded by weakness in fundamentals. Typically, what we would see is that earnings projections start to fall. We may see concern that companies are unable to finance their debts. So we see high yield spreads widening out. We're not really seeing that kind of reaction right now. So that tells us that this sell-off right now is mostly predicated on weaker sentiment, that if tariff policy were enacted as in some of the more extreme fashion that we're hearing about, that is what could probably lead to more concern about economic growth going forward. But we really think that this will be resolved fairly quickly and we'll move on to the more positive aspects of policy.
Tracie, you came into this year overweight U.S. assets, overweight the dollar, overweight on stocks. I just wonder how long you're willing to wait before you change your view, or you have conviction in going in right now and buying on this dip.
So we do have conviction. In fact, we just recently made an adjustment to our allocations where we pulled back some of our allocation to intermediate term fixed income, and we moved that over to mid-cap stocks. What we're seeing here is capital gains in our fixed income holdings that we want to take advantage of, move that into a segment of the U.S. market that we think could benefit from some of the policy action in the second half of the year. So we think that once we get past some of the tariff negotiations, that CEO confidence will be revived. That could lead to additional mergers and acquisitions. That could benefit mid-caps. And we also see that mid-caps are almost as high quality as large caps, but often they get lumped in with small caps, which are much lower quality.
Tracie, appreciate your view on the market. Tracie McMillion there of Wells Fargo. Just to bring you an update on the markets right now, equity futures on the S&P 500 down by 0.4%. No real drama there. In the bond market, bond yields are higher by 2 basis points, 433. Just want to note, a little bit of economic data later, 8:30 Eastern Time, 22 minutes from now, you'll get US PPI and you'll get jobless claims as well. If you are just joining us, welcome to the programme. Let's turn back to global trade. Canada striking back against President Donald Trump's metals tariffs, slapping 25% levies on over $20 billion of American goods. Canadian officials coming to the bargaining table today. You'll hear from the Finance Minister, Dominic LeBlanc, and the Ontario Premier, Doug Ford, set to meet with the Commerce Secretary, Howard Lutnick. And I'm pleased to say that Commerce Secretary Howard Lutnick joins us now from Washington, D.C. Mr. Secretary, welcome back to the programme, sir. Always appreciate your time. If we could just take a step back and set the table, what are the stakes for today's meeting between you and Canadian officials?
Well, I think the stakes today, if you take a look at it from the big picture, is the United States said we need to have steel and aluminum domestically in America. In national security, you need metals to make bullets, you need metals to make munitions, you need metals to make everything. And Donald Trump is very focused on, let's make sure the key ingredients that are necessary to defend America are made here in America. And these other countries, they just don't pay attention. I mean, how many times do I have to say national security is important? And if you do like the EU and you respond by putting a tariff on Kentucky bourbon, which used to piss off Mitch McConnell, which doesn't really matter anymore, you got to wonder, really, do I have to deal with this stuff? But alas, we do.
Mr. Secretary, let's get to Europe in a moment. Let's just stay on Canada, and then we'll work our way to the EU if we can. For the Canadians, as you know, they've put tariffs on around $21 billion of US goods. Will that change your approach to today's meeting?
Well, I mean, take a look at that again. Let's take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA?
Well, USMCA, we set aside USMCA. So the United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect Canada. I think Canada's got 60 planes. Oh yeah, they're really going to protect themselves. They're the lowest investor in NATO. They totally rely on us, and yet they think they need to respond to steel and aluminum tariffs. I mean, everybody is so used to picking off America, so used to it that they can't even stop. Donald Trump is here to say we need to be treated fairly, and we need to be treated fairly now.
Do you think this approach, if you articulate this to the Canadians today, will help bring down the temperature?
I do. I think once you actually breathe and think steel and aluminum, America needs steel and aluminum. I mean, if you respond like the British didn't respond, the Mexicans didn't respond, you have some countries that actually thoughtfully examine how they do business with us. And then you have people like the Canadians who are in elections, so you have no idea. You think it's about a trade war. This is their way of getting election votes. And the EU, the EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect, and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together. We're going to describe our trading policy. We're going to describe our balance. But remember, semiconductors, we need to have them in America. Pharmaceuticals, we need to have in America. Cars, we need to have in America. And steel and aluminum, come on. America, and lumber as well.
And
These
wine
are
and champagne.
Important things for our national security.
And the wine and champagne, sir. Don't forget the wine and champagne.
Come on, that's just that. If you make him unhappy, he responds unhappy. But come on, let's get back to the core basics here, which is a trading policy that says America has allowed the world to lean on us, to take from us, to grow off of us, and now it's time for a little balance. We've got a $2 trillion budget deficit. We want to bring certain jobs home. Let the president do the right thing for America. He will respond after we're done organizing things to make sure the world grows. But today, just remember, he's the president of the United States of America. He's not the president of the world. He's going to take care of American workers, and it is time.
Mr. Secretary, I just want to make sure that the audience is in on our little joke there, because they might have missed the post for the president a couple of minutes ago. So I'm going to share it with them and then come back to you in just a second. So the president of the United States put this out on Truth Social moments ago, said the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world, which has formed for the sole purpose of taking advantage of the United States, has just put a nasty 50% tariff on whiskey. If this tariff is not removed immediately, the United States will shortly place a 200% tariff on all wines, champagnes and alcoholic products coming out of France and other EU-represented countries. So, Mr. Secretary, just to bring you in, I imagine you are aware of what the president said based on our conversation just now. Have you given the Europeans a warning on this? Have you given them a time limit to back away? Are you taking the same approach you did with the Canadians just a few days ago?
Well, I think the president has made it crystal clear that he finds this tit for tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America, because that's important. And then, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security. Whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley Davidson motorcycles and Kentucky bourbon? It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. He wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
Do you have plans to speak to your European counterparts today?
Of course.
Like who? Are you speaking to, say, Ursula von der Leyen, or potentially some heads of companies like Bernard Arnault, who was also at the president's inauguration?
Generally, as the Commerce Secretary, I speak to the trade ministers. That's generally how it goes.
But a lot of companies also, and I know executives, have been calling you, sir. Is that not correct? They're looking for exemptions. Exemptions, carve-outs, fall squarely in the Commerce Department.
So let's talk about exemptions for a moment. Steel and aluminum tariffs went in 2018. And when we came back into power, the Biden administration had granted 490,000 exemptions. Imagine 490,000 exemptions to steel and aluminum tariffs. I mean, I don't know that our department could actually collate 490,000 Christmas cards, let alone 490,000 steel and aluminum tariffs. I mean, come on, it's ridiculous. So yesterday, what we did is we just got rid of all the exemptions. That's all we did. The steel and aluminum tariffs were already on. We just said, look, let's just build back our steel and aluminum industry in America to protect America. It's so logical. It's so important. Yeah. And then all we get, you get some countries who understand and some countries who just go right back to old school. And, the president's going to deal with them with strength and with power. And he's remembered that they like to respond with just go after their wine and maybe they'll pay attention and listen. But the fact is, April 2nd, we're going to go with reciprocity, thoughtful, global process.
Secretary Lutnick, it's going to take a while to actually get those tariffs in place after all of the appeals process, et cetera, after April 2nd. And in the meantime, as all of these discussions around tariffs continue, a lot of businesses are just halting investments. You're seeing consumer sentiment decline. You're seeing their spending activity decrease. Can you give them a sense of when they'll have certainty?
The opposite actually is coming true. You saw Apple, $500 billion. You saw SoftBank, $200 billion. Eli Lilly, $40 billion. I'm meeting a company today who sent me a note saying they want to invest $65 billion in America. The scale by which American companies are committed to invest in America and global companies.
Secretary Lutnick, excuse me, what I'm talking about,
huge,
let me explain to you what I'm talking about.
Investments, and those are coming. Well, let me finish. These are huge investments coming to America. You're over $1.7 trillion committed in Donald Trump's first 50 days. Anyone who thinks people are uncertain doesn't understand what Donald Trump is saying. He's saying, bring your production to America and you will avoid all the tariffs. Come build in the greatest economy in the world, and you will avoid tariffs.
That's maybe long term, but what we're seeing in the short term is that small business confidence has fallen to a 4-month low. They say a high degree of uncertainty about what the regime is going to look like. They talk about increasing likelihood of having to increase prices in response to the tariffs. You're seeing this with respect to airplane tickets that are falling off a cliff as of February. I'm just wondering, when you take a look at these types of indicators, at what point does it become concerning to you?
The greatest deal maker who's ever lived is sitting behind the desk in the Oval Office. He understands that the best way to get our farmers, our ranchers, and our fishermen's produce and products in the rest of the world, which they block it. I mean, India blocks our farmers. All these countries block our farmers. The way to grow it is to make deals with them where they have to understand the power of the U.S. economy is that you need to take our products. We want to unleash American ingenuity and the capacity to export. And when other countries put giant tariffs on our products, let's be clear. You can't go to Europe and see an American car. You can't go to Korea and see an American car. You can't go to Japan and see an American car, but you sure see their cars here. So the concept of Donald Trump saying, hang on a minute, you have got to be kidding. We need to unleash the American economy, and if we've got to teach the rest of the world to treat us with respect, that they have beaten on us and they have abused us, and their tariffs are so high that they've got to actually treat us with respect, bring down their tariffs so that it's reciprocal. Remember, they will never live with us having the tariffs as high as they have them. So what they're going to do is they're going to bring them down. Let Donald Trump run this economy. He knows what he's doing better than any president who's ever sat at that desk. Let him do his job. There's going to be a lot of talking, but in the end, there's going to be the greatest growth economy America's ever seen. We are going to export, and people are going to build in America. Those two things are going to happen, and they're going to happen because Donald Trump's going to create fair trade. Start saying the word fair trade, because right now, trade in America, go look at the numbers, unfair. Europe, huge. India, huge. Right? China, the highest. There's no inflation in these countries. What there is blocking Americans from doing business there, and Donald Trump is going to break down those walls.
Let's talk about China. So we heard from a foreign ministry official in China who said this, that Beijing has done the United States a favor and Washington should have said a big thank you for all they've done to control drugs. And I imagine they're alluding to fentanyl directly. Mr. Secretary, I just wonder if the president has seen those comments in the last 24 hours and what his response is to them.
The president, as we have said, on April 2nd is going to take a holistic approach to everything. March has been the month to reduce the border and fentanyl deaths in America. And I hope to God China's reducing the production of the fentanyl ingredients that kill 75,000 autopsied Americans. And as the president rightly knows, that number is way more. We need them. We need China to stop making the ingredients, and we need Mexico and Canada to stop shipping them into our country. That is March. March is very focused on that. Hopefully they'll get down and we'll have a good a good reduced border. Obviously, that's so far so good, but we need to reduce those fentanyl deaths. And then come April, you're going to see us start to focus on lowering tariff away and increasing tariffs at home, so at least we get a little balance. If they want to lower them, reciprocal tariffs mean take them down, and we'll keep ours down.
Have they given any indication they're willing to do that? Because you've been ramping up tariffs over the last month on China. Have they given any indication they're prepared to do that? Just to stress test this theory, because tariffs have been ramping up on China over the last 10 years now. Any indication they're willing to actually step back and do what you're asking them to do?
You know, China is always a separate thinking. You know, the Chinese Communist Party thinks about things in a much, much different way than everybody else. And I don't know how they're going to deal with bringing these things down. I would like them to bring it down. They have a huge market. But remember, we consume more than 2 times what they consume. They have a big economy, but they're a production economy. They sell to us. They need to sell to us. We are the greatest consuming economy in the world. We are the customer that everybody in the world needs. Now, they've put huge tariffs in China because they're trying to build up their consumer production domestically. And that's where they stand. So you don't hear all of you talking about how horrible China is and all the inflation in China and all this sort of stuff. It's just not true. The fact is, America is going to build up its industries here, drive down tariffs there. I don't know what China will do, but my expectation is the whole world who trades with us will bring down their tariffs and allow our farmers, ranchers, and seamen, allow our production, allow our car manufacturers to export more and grow. We are looking for fair trade.
Secretary
Fair
Lutnick?
trade. Let's say it over and over again.
We got it. I think it could maybe be a bumper sticker for you. There are reports this week that potentially underway are plans for Xi Jinping to meet with Donald Trump. Are we expecting a meeting between these two leaders either in the spring or early summer?
I mean, look, the president runs his agenda, but from my perspective, when strong leaders meet each other, that is useful and effective for the world. But Donald Trump will make those decisions himself. I am focused on reciprocal tariffs. On April 2nd, I am not in the agenda of who President Trump decides he wants to meet.
Secretary Lutnick, we're just 2 minutes away from the latest indicator from the United States, which is PPI data and inflation rate and initial jobless claims. You've talked about how the data that we are getting right now is Biden data. At what point does it become Trump data?
I'd say we fully wear the fourth quarter, and we may well wear much of the third quarter. But for fourth quarter, for sure. You know, the American economy, right, a $29 trillion economy. You can't take office on Monday and have the news media say, oh, look what you did on Tuesday. I mean, come on, that's so silly. So the real way the world works is, for sure, the fourth quarter is Donald Trump's quarter, and the third quarter, his policies start to really embed in America. So that's the right way to look at it. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates because you got all these companies committing to build in America, get their shovels in the ground because we get regulations out of the way, start to produce those jobs, start to bring back trade craft. You know, electricians who build giant factories, HVAC specialists who cool those, and then mechanics who fix robots. You've got tradecraft coming back to America. It's going to be amazing. We're going to have the greatest training program ever because we need to train our great workers for the AI revolution and the tech revolution that is coming, that Donald Trump is bringing to construction and development in America. And we need to train our people, and they're going to have great jobs.
So going forward, do you just look through all of this weakness? You've talked about how, and we've heard a sort of detox period, et cetera. Do you look past all of the data in the first and the second quarters as simply backward looking and look forward to what deals are getting done?
My job is to look forward to what deals are getting done. I'm going to bring in, because Donald Trump has created the policies for me, to bring in enormous investment to the country, 1.7 trillion so far committed. And we're going to put out a website and literally show these companies construction and manufacturing in America quarter by quarter to show this kind of growth. Remember, each trillion of this kind of committed construction is worth 1 point of GDP. So at 2 trillion, which we definitely will have for sure, that's a half a point of GDP for all 4 of his years. So as that grows, you're going to see that growth come into our GDP numbers. Obviously not today. Someone says, I'm going to build 65 billion in America. When can they get in the past, it would take 1.5 years to get the permits to build. Under Donald Trump, it's going to take less than 6 months. They're going to be in the ground this year, and the fourth quarter, you're going to see this power. So, yes, do I have to say the first quarter is surely Biden, the second quarter is Biden, but starting the third quarter, you start to feel some Donald Trump, and the fourth quarter, you will feel the power of Donald Trump's economy.
Secretary Lutnick, I'm sure you've seen this report in Politico. It says that White House officials, Trump outside allies are, quote, growing increasingly frustrated with you, sir, privately complaining about the close proximity.
You got to stop the fake news. Please,
hold on.
God,
I want
stop
to give you the chance,
news.
sir, to respond to this.
Stop the fake news. I don't want to respond. When you read fake news, okay, I spoke to the president last night. He said, why do these people write this fake news? It's just nonsense. Imagine Jameson Greer, who's our USTR, who works with me. And obviously, if you remember when the president nominated me, he nominated me to say, go select a USTR and work closely with him. Anybody who says this kind of stuff, these articles talk about the Council of Economic Advisors. They're not even populated yet. The nonsense that we have to read while people just are trying to be troublemakers where it's entirely fake news. I don't need to respond. Okay, I really don't need to respond. I speak to the president all the time. Our economic team is one. We are together as one. We get along incredibly well. We speak to each other all the time, including yesterday for an enormous amount of time, every day, today again. It's got to stop. I mean, look, these lousy, media outlets, they try to create something so that you'll talk about it. Think about it. They got you to talk about them. I don't even want to say their name. They don't deserve to be read because it's nonsense.
Out of respect for you, sir, we just wanted to give you the opportunity to respond, and in your own way, I think you have. Mr. Secretary, thanks for being gracious with your time. You've been very generous. Appreciate it. We've got to get to some Biden data. Commerce Secretary Howard Lutnick there. Let's get to that economic data. I'm joking. PPI and jobless claims out just moments ago. Mike McKee has the information for us. Good morning, Mike.
Morning, John. I'm not sure this is Biden data because yesterday the CPI came out lower than expected, and the administration called it Trump data. Today, lower than expected. So let's see what they say about this. PPI comes in just flat for the month of February. The expectation was it would be up 0.3%. It was up 0.6% the month before. So a significant slowing in producer price inflation. The core is down 0.1%, and the core ex-trade is up just 0.2%. So on a year-over-year basis, headline 3.2%. For year over year, and the core 3.4%, ex-trade 3.3%. These are all signs of significant progress on the wholesale level. Jobless claims, 220,000. That's down from 222 last week, and it does show there hasn't been much change in the labor market. Continuing claims, 1,870,000, down from 897,000. Federal claims for the last week, 1,580, which is a decline from last week's number. But we're going to start changing the data point that we care about and look at continued claims for federal workers. That'll give us a count, 8,215. That's an increase of 803 from the previous week. So progress being made. One other point for the PPI. A lot of the PPI is lower, but interestingly enough, steel prices, aluminum prices, both went up in the last month, perhaps in anticipation of the tariffs. And then the things that go into PCE, like airline fares were flat last month, same as the opposite of what happened with CPI. And so that should be good news for PCE, portfolio management, up by 0.5%. That will feed into PCE on a negative side.
Mike McKee, thank you, sir. So for the second straight day, we've had a softer than expected inflation read. Yesterday was CPI. This morning is PPI. Just want to draw your attention to the bond market. Just take a look at this. You'd expect yields to be dropping. They're not. Again, they're higher on a 10-year by about 2 basis points to 433. I don't think these moves are large. I don't think they're big. But I think the direction is interesting and suggests that maybe the market is focused on something else. And that something else might be the threat of further tariffs. This came from the president just about 30 minutes ago. The United States will place a 200% tariff on all wine, champagnes and alcoholic products from France and other EU countries. This was in a Truth Post social post just moments ago. The president saying he will place the tariff if the EU does not remove its 50% tariff on whiskey. I think that's the issue right now this market's got, Lisa. Just how relevant is the economic data going into the Federal Reserve next week when we've got the threat of policy changes that could completely change what this data looks like right now?
You're picking up on exactly the right thing, which is that backward-looking inflation data has less relevance than, say, the labor market cracking, which might give the Fed the excuse to cut rates. What you're seeing right now is disinflation. Yay. Otherwise, that might give a pass to the Fed. But what you're seeing is a labor market that's holding in there better than people expected. So instead of focusing on the disinflation, people are looking to the tariffs and saying, forward-looking, they're going to have a very difficult scenario on their hands. Front-end yields up. And that, I think, is notable. With
us around the table, Nela Richardson of ADP. Nela, good to see you. Good morning.
Great to be here.
Let's talk about this data. How relevant is it for the Federal Reserve, for anyone setting policy right now?
It's relevant because it gives us a baseline. And that baseline is strong. You see inflation moderating. You see the jobs market holding pace, unemployment low. So overall, the U.S. economy, despite the uncertainty and the malaise and haze of uncertainty, the U.S. economy is still solid. What we have to learn now how to do in this transition period is drive through the fog. Can we still grow? Can we still maintain? Can inflation still moderate? And importantly, can firms still hire when under foggy conditions instead of clear ones?
In the fog, people are looking for some sort of little lights to get a sense of what direction we're going in. And one of those lights was the guidance from some of the big airlines talking about travel, particularly from businesses cutting back. How much do you see that as an indicator of companies taking the first steps to trim costs before taking that extra step of cutting jobs?
Right. Well, we've already seen it in the data at ADP when we put out our national employment report. There is a hiring hesitancy, and that is completely in line with not knowing what the economic climate is. So you think about airlines and airline prices and business travel and whether the consumer, which has been trending softer and weaker as well, will show up at the airport. So while there's a lot of well-deserved attention on tariffs, let's not lose sight of the consumer whose spending has slowed in this interim, and they're anchored on higher prices, not necessarily lower inflation, which could mean that their spending patterns also slow simultaneously with this increase in uncertainty.
We were speaking earlier today with former New York Fed President Bill Dudley, who said this market seems to think that there's going to be some sort of Fed relief valve. He doesn't see it because he doesn't think the unemployment rate's going to really creep up all that much. And that is sort of the key indicator for this Federal Reserve to cut rates. It seems like initial jobless claims weren't out of the ordinary, 220 versus actually expected 225,000. Do you agree with Bill Dudley?
Yes, I actually think that you might see unemployment rates creep down and before they trend up again. If you look at the data, what it suggests is a certain stasis, and we've talked about this, a certain stability in the labor market, especially looking at ADP data, we see a stability in small firms. There's not a lot of turnover there. There's not a lot of separations. There's not a lot of layoffs. And importantly, there's not a lot of hiring. On the large firm side, higher turnover, which is consistent with an unemployment rate that is either holding steady or going down, as there's still some opportunities with these larger firms. So overall, the labor market picture is holding up. So there's not a lot of wiggle room for the Fed, because that holding up could turn into labor market tightness pretty quickly.
Why is this number 220,000? And I ask this because a lot of us were expecting to see the results of some of the Doge cuts in these data, and we don't seem to be seeing a material tick up. If anything, the jobless claims went down.
These are early innings. and the response has not been completely incorporated into hiring decisions across the board. Also, this isn't a macro indicator. Really, the heat comes from the sector analysis, the fine grain data. So when you look at the data in terms of education, healthcare, you see a lot of hesitancy. In fact, a real slowdown in that sector in response to new decisions on federal grants to universities, hospitals, and social assistance. So these effects are going to ripple through the economy in different ways at different times. So a headline number, it's not going to tell you the whole story. It's just going to tell you a piece of it. And that piece is still important to the markets, that the labor market still looks solid.
Nela, appreciate it. The good news, the baseline's still pretty decent. Nela Richardson there of ADP. Thank you, Nela. Thank you very much. Joining us now is Cayla Seder of State Street. Cayla, welcome to the programme. This came from Torsten Slok of Apollo. I'd actually love your thoughts on it. So he said this is the wait-and-see economy, went on to say that in a wait-and-see economy, it eventually leads to a slowdown in the hard data. Do you think it's premature to extrapolate the weakness we're seeing in the survey data into the hard data anytime soon?
Well, first, thank you so much for having me. And yeah, I do think it's a little premature, especially because when we do see some of the hard data, it still looks strong. And some of that more high frequency hard data still looks strong. So, you know, the claims data we got today looks okay. When we look at some of the consumer credit lending data, credit card lending is still very strong. So from that perspective, you know, that tells me it's hard to bet against the U.S. consumer right now, even though uncertainty is higher than it was before.
Cayla, do you think that this market has overpriced some of the weakness that we've seen in the soft data and extrapolated it into a pretty big economy that is pretty solid? Or do you think that right now the market's picking up on something that could come to pass in, say, 6 months' time?
You know, I think from here, when it comes to expectations for the Fed and Fed cuts, 3 cuts right now, you know, looks like that looks to me like the market is pricing in more uncertainty. However, to get more than that priced in is going to be really hard. I think you need to see more of that weakness in the hard data that we haven't seen just yet.
Which is the reason why right now the bond market's move is so interesting. On the heels of this data that came out just 13 minutes ago about, we're looking at bond yields creeping higher even on the front end, even though we did see that disinflation continue with PPI coming in softer than expected. It seems like the bond market, as John was saying, is looking at something else and expecting the Fed to be on hold for a longer period of time. Do you think that is the correct response? Do you think that bonds don't offer the same kind of ballast as they have in the past?
I still think cash is the better decision right now for a couple of reasons. One is that the front end of the yield curve, so thinking bills versus 2 years, that's still inverted. And, you know, as previous speakers mentioned, the Fed isn't in a position to cut just yet. And I think as well, when we look at where we see the market increasing rate cut expectations, it's not, you know, it's not for next week. It's not for the May meeting either. And so that keeps cash pretty attractive right now.
Bond yields higher across the curve at the moment on the 10-year, up by 2 basis points at 4.33. Cayla, we've got to leave it there. Cayla Seder there of State Street on the bond market. Following economic data, the kind of economic data that if you're the Federal Reserve, this is what you want to see. Softer on CPI, softer on PPI, going into the Federal Reserve meeting next week. Make it easy breezy. Inflation's trending in the right direction. We can maybe reduce interest rates over the next 12 months or so. They can't do any of that. They can't do any of that because they don't know what policy is going to be down in Washington, D.C.
And in some ways, they could probably say policy's been a pretty good place, at least if you take a look at the jobless claims. But again, this is backward looking. Everyone is saying that. And when you look at the high frequency data, this is the reason why, and I keep going back to this, Stuart Kaiser said that the University of Michigan sentiment survey tomorrow is oddly important. It might be the most important data point of the week because we'll get inflation expectations and sentiment, and that seems to be in the driver's seat.
The policy is frenetic at the moment. Just 45 minutes ago, the President of the United States is talking about a 200% tariff on EU wine, champagne, and other alcoholic beverages unless they strip away their 50% on whiskey. And Secretary Lutnick comes on this program and says, we're done with this tit for tat. But you look at what allies are saying, and they're saying, but you started it. We would like to have a negotiation, but you come out with truths saying we're going to go to 50% on steel just on Canada, 200% just on Europe.
There was a piece of that interview that jumped out for me, and he alluded to this. He didn't say it explicitly, but the idea of dealing with China was different. Because we asked the question, if you put tariffs up on China, is there any evidence at all that China are reducing theirs in response to that, if that's the desired outcome? And at the moment, over the last several years, we've seen no such outcome whatsoever from the Chinese Communist Party. Almost alluded to the idea that it was easier to bully democracies that are accountable to their own electorate because they have to respond, they have to take the temperature down because they know the economic consequences won't be good.
There's been a different approach, not just with China and the leadership there, but also with Russia and some of the autocracies that are not guided by the same types of democratic principles have had a quieter time of it, which is sort of interesting in terms of negotiating tactics. But ultimately, there might be different outcomes, too, that are desired.
Also, China did not live up to Trump 1.0 phase one trade deal. And I imagine that is in the back of their mind. So they're not willing to negotiate at this moment yet with China, though there are reports that potentially there's a meeting underway that could happen in the spring, early summer. Did you notice Secretary Lutnick did on this instance not want to get ahead of the president?
Yes, a shift, a change. I will take note of that. Equity futures right now in the S&P negative by 1/3%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Just the details of what President Donald Trump said on those tariffs. He's threatening to enact a 200% tariff on European wine, champagne, and other alcoholic beverages. The president writing in a Truth Social post that he will move forward with the duties if the EU doesn't repeal a tax on U.S. whiskey. The Federal Trade Commission, meanwhile, is moving ahead with an antitrust probe of Microsoft that was open to the final days of the Biden administration. Bloomberg has learned that the FTC is scrutinizing Microsoft's decision to slash funding on its own AI projects after striking a deal with OpenAI, which could be perceived as hurting competition. 2 NASA astronauts stuck in space will have to wait a little bit longer to get home. A launch pad problem prompted SpaceX to delay a flight to the International Space Station, and the crew needs to get to the International Space Station before Butch Wilmore and Suni Williams can head home after 9 months in orbit. And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead and give you a sneak peek of next week as well. From New York City, this is Bloomberg. The opening bell about 40 minutes away. Equity futures going into that declining just a touch. We're down by 0.25% on the S&P. On the Nasdaq 100, lower by 0.4%. The trading diary through the next week or so looks like this. At 12:20 Eastern Time, President Trump meeting with the NATO Secretary General on Friday. UMich consumer sentiment, another important read on inflation expectations. Then at midnight, a U.S. government shutdown deadline. Sneak peek of next week, retail sales on Monday. Wednesday, a Fed rate decision and an important Chairman Powell news conference. Also important, of course, is what is happening with the relationship between the United States and a range of allies, including the EU. Take a listen to what the Commerce Secretary Howard Lutnick said just moments ago about the European Union.
The EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together.
Let's bring in Tyler Kendall from the nation's capital for more down in Washington, D.C. Tyler, the president saying more than balance this morning. Pretty strong message for the Europeans about an hour ago.
Right, John, that post on Truth Social, President Trump threatening up to 200% tariffs on alcoholic goods. It was interesting to hear Howard Lutnick on this program saying that President Trump was, quote, aggravated by the response that he saw from the EU and that this White House wants to see partners like Canada and the EU start to negotiate a little differently here, like they've seen from Mexico and the UK, for example. You'll recall when the UK Prime Minister Keir Starmer was here at the White House last month, President Trump was pretty open that he much prefers to negotiate with London over Brussels. I was also struck by in that interview that he gave us some indications on when this White House is going to start to transfer from what they have been calling Biden data to Trump data, telling us to look ahead to the fourth quarter.
When it comes to today's meetings, Tyler, it's going to be all about Canada. And Howard Lutnick in that conversation said a lot of what's being driven in terms of Canada and what he would maybe say they're posturing comes from domestic political considerations. If that's how they're going into this meeting, that kind of mindset, what do you think we're going to get out of it?
That is the biggest question here, perhaps, and important to note that at the meeting also will be Ontario's premier, who Howard Lutnick has already negotiated with at least once this week to get them to drop that 25% electricity tax in order to have this meeting today. What this White House really wants, it remains to be seen. This interview from Howard Lutnick really pushing that they are trying to rebalance trade, make this all about those reciprocal tariffs. But we know going into today, this White House has put a lot of factors on the table, from border to national security to also how they'd like to see tariffs used as a revenue raiser.
Hey, Tyler, appreciate the breakdown. Great summary of things right now. Busy day ahead for everyone down in Washington, D.C. Bloomberg's Tyler Kendall there. Lisa, we did get one answer, one very clear answer. Biden data versus Trump data. Right? We figured this out? We've got a calendar now?
We've got a calendar. Trump data is third quarter, maybe, but definitely fourth quarter. Okay. Biden data is first quarter and second quarter. So what we're looking at right now is Biden data. And what the Biden data shows right now is initial jobless claims that came in lower than expected and disinflation in the actual PPI, although maybe with the bond market stiffing out, revisions to the upside on the prior PPI reading. So still an inflationary undertone here that has some people's attention.
One thing that they're taking full credit for, maybe Trump capital investment, say Howard Lutnick brought it up. Apple's $500 billion. Actually, that started previously years ago, and a lot of that happened under the Biden administration, but obviously he's not going to point to that. I'm struck this morning by the president coming out with 200% tariff on EU wine, not because we haven't seen a chaotic, frenetic rollout, but also because you can imagine his friend, who he likes to consider his friend, Bernard Arnault, the shares of LVMH this morning are now taking a hit because of this. What kind of carve-outs potentially can we see with this administration? Because Howard Lutnick's basically saying there are none.
We're opening up a major debate without realising it. Can you substitute French wine for Napa Valley wine? I say.
Okay, really?
I'm old world. I'm an old world girl, so no.
First of all, they all have different tastes. You taste the land. It's enjoyable to taste different land.
Nice.
It's like traveling through a bottle.
Opus one's pretty good.
Yeah, I know.
You know, it's like this.
I'm shocked you brought that up.
I remember once.
Good wine.
Do they subsidize you?
I remember once for dinner, Obama did Virginia champagne. I'm not sure it landed.
I've been down there. I've seen all those barrels.
Oh, I know you have.
Yeah, no.
Yeah, every time.
That's good stuff. All right. Coming up tomorrow, Chris Verona of Strategas, Jessica Taylor of the Cook Political Report, Maya McGuinness of the Committee for a Responsible Federal Budget, and the NATO Secretary General Mark Rutte. Looking forward to doing all of that and more as we make our way into the weekend. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. New mom Belinda Bencic continued her dream return to the WTA Tour with a thrilling three-set victory over Coco Gauff to reach the quarterfinals. The victory follows her triumph in Abu Dhabi last month and was her first top-3 win since beating Jessica Pegula in Charleston 2 years ago.